Open a ZERODHA account. Chapter 1. Introduction to Fundamental Analysis. 1.1 Overview. Fundamental analysis (FA) is a holistic approach to study a business. When an investor wishes to invest in a business for the long term, say 3 to 5 years, it becomes extremely essential to understand the business from various perspectives. It is critical for an investor to separate the daily short-term noise in the stock prices and concentrate on the underlying business performance. Over the long term, the stock prices of a fundamentally strong company tend to appreciate, thereby creating wealth for its investors. We have many such examples in the Indian market. To name a few, one can think of companies such as Infosys Limited, TCS Limited, Page Industries, Eicher Motors, Bosch India, Nestle India, TTK Prestige, etc. Each of these companies have delivered on an average over 20% compounded annual growth return (CAGR) year-on-year for over 10 years. To give you a perspective, at a 20% CAGR, the investor would double his money in roughly about 3.5 years. Higher the CAGR, faster is the wealth creation process. Some companies such as Bosch India Limited have delivered close to 30% CAGR. Therefore, you can imagine the magnitude and the speed at which wealth is created if one would invest in fundamentally strong companies. Here are long-term charts of Bosch India, Eicher Motors, and TCS Limited that can set you thinking about long-term wealth creation. Do remember, these are just 3 examples amongst the many that you may find in Indian markets. At this point you may be of the opinion that I am biased as I am selectively posting charts that look impressive. You may wonder how the long-term charts of companies such as Suzlon Energy, Reliance Power, and Sterling Biotech may look. Well, here are the long-term charts of these companies. These are just 3 examples of the wealth destructors amongst the many you may find in the Indian markets. The trick has always been to separate the investment-grade companies which create wealth from the companies that destroy wealth. All investment-grade companies have a few common attributes that sets them apart. Likewise, all wealth destructors have a few common traits which is clearly visible to an astute investor. Fundamental analysis is the technique that gives you the conviction to invest for a long-term buy, helping you identify these attributes of wealth-creating companies. 1.2 Can I be a fundamental analyst? Of course you can be. It is a common misconception that only chartered accountants and professionals from a commerce background can be good fundamental analysts. This is not true at all. A fundamental analyst just adds 2 and 2 to ensure it sums up to 4. To become a fundamental analyst, you will need few basic skills. Understanding the basic financial statements. Understand businesses with respect to the industry in which it operates. Basic arithmetic operations such as addition, subtraction, division, and multiplication. The objective of this module on fundamental analysis is to ensure that you gain the first 2 skill sets. 1.3 I'm happy with technical analysis. So why bother about fundamental analysis? Technical analysis (TA) helps you garner quick short-term returns. It helps you time the market for a better entry and exit. However, TA is not an effective approach to create wealth. Wealth is created only by making intelligent long-term investments. However, both TA and FA must coexist in your market strategy. To give you a perspective, let me reproduce the chart of Eicher Motors. Let us say a market participant identifies Eicher Motors as a fundamentally strong stock to invest, and therefore invests his money in the stock in the year 2006. As you can see, the stock made a relatively negligible move between 2006 and 2010. The real move in Eicher Motors started only from 2010. This also means FA-based investment in Eicher Motors did not give the investor any meaningful return between 2006 and 2010. The market participant would have been better off taking short-term trades during this time. Technical analysis helps the investor in taking short-term trading bets. Hence, both TA and FA should coexist as a part of your market strategy. In fact, this leads us to an important capital allocation strategy called the core satellite strategy. Let us say A market participant has a corpus of 500,000 rupees per. This corpus can be split into two unequal portions. For example, the split can be 60 to 40. The 60% of capital, which is 300,000 rupees per, can be invested for a long-term period in fundamentally strong companies. This 60% of the investment makes up the core of the portfolio. One can expect the core portfolio to grow at a rate of at least 12% to 15% CAGR year-on-year basis. The balance 40% of the amount, which is 200,000 rupees per, can be utilized for active short-term trading using technical analysis technique on equity, futures, and options. The satellite portfolio can be expected to yield at least 10% to 12% absolute return on a yearly basis. 1.4 Tools of FA. The tools required for fundamental analysis are extremely basic, most of which are available for free. Specifically, you would need the following. Annual report of the company. All the information that you need for FA is available in the annual report. You can download the annual report from the company's website for free. Industry-related data. You will need industry data to see how the company under consideration is performing with respect to the industry. Basic data is available for free and is usually published in the Industries Association website. Access to news. Daily news helps you stay updated on latest developments happening both in the industry and the company you are interested in. A good business newspaper or services such as Google Alert can help you stay abreast of the latest news. MS Excel. Although not free, MS Excel can be extremely helpful in fundamental calculations. With just these 4 tools, one can develop fundamental analysis that can rival institutional research. You can believe me when I say that you don't need any other tool to do good fundamental research. In fact, even at the institutional level, the objective is to keep the research simple and logical. Key takeaways from this chapter. Fundamental analysis is used to make long-term investments. Investment in a company with good fundamentals creates wealth. Using fundamental analysis, one can separate out an investment-grade company from a junk company. All investment-grade companies exhibit few common traits. Likewise, all junk companies exhibit common traits. Fundamental analysis helps the analysts identify these traits. Both technical analysis and fundamental analysis should coexist as a part of your market strategy. To become a fundamental analyst, one does not require any special skill. Common sense, basic mathematics, and a bit of business sense is all that is required. A core satellite approach to the capital allocation is a prudent market strategy. The tools required for FA are generally very basic. Most of these tools are available for free. 65 responses to Introduction to Fundamental Analysis. Open a ZERODHA account. Chapter 2. Mindset of an investor. 2.1 Speculator versus trader versus investor. Depending on how you would like to participate in the market, you can choose to speculate, trade, or invest. All the 3 types of participation are different from one another. One has to take a stance on the type of market participant he would like to be. Having clarity on this can have a huge impact on his profit and loss account. To help you get this clarity, let us consider a market scenario and identify how each one of the market participants, speculator, trader, and investor, would react to it. Scenario. RBI in the next 2 days is expected to convene to announce their latest stance on the monetary policy. Owing to the high and sticky inflation, RBI has hiked the interest rates during the previous 4 monetary policy reviews. Increase in interest rates, as we know, means tougher growth prospects for corporate India, hence corporate earnings would take the hit. Assume there are 3 market participants, Sunil, Tarun, and Gorish. Each of them view the above scenario differently, and hence would take different actions in the market. Let us go through their thought process. Please note, I will briefly speak about option contracts here. This is only for illustration purpose. We will understand more about derivatives in the subsequent modules. Sunil. He thinks through the situation and his thought process is as follows. He feels the interest rate are at an unsustainably high level. High interest rates hampers the growth of corporate India. He also believes that RBI has hiked the interest rates to a record high level and it would be really tough for RBI to hike the rate again. He looks at what the popular analysts on TV are opinionating about the situation, and he is happy to note that his thoughts and the analyst thoughts are similar. He concludes that RBI is likely to cut the rates if not for keeping the interest rates flat. As an outcome, he expects the market to go up. To put his thoughts into action, he buys call options of State Bank of India. Tarun. He has a slightly different opinion about the situation. His thought process is as below. He feels expecting RBI to cut the rates is wishful thinking. In fact, he is of the opinion that nobody can clearly predict what RBI is likely to do. He also identifies that the volatility in the markets is high. Hence, he believes that option contracts are trading at very high premiums. He knows from his previous experience via backtesting that the volatility is likely to drop drastically just after RBI makes its announcement. To put his thoughts into action, he sells 5 lots of Nifty call options and expects to square off the position just around the announcement time. Gurush. He has a portfolio of 12 stocks which he has been holding for over 2 years. Though he is a keen observer of the economy, he has no view on what RBI is likely to do. He is also not worried about the outcome of the policy as he anyway plans to hold on to his shares for a long period of time. Hence, with this perspective, he feels the monetary policy is yet another short-term passing tide in the market and will not have a major impact on his portfolio. Even if it does, he has both the time and patience to hold on to his shares. However, Gurush plans to buy more of his portfolio shares if the market overreacts to the RBI news and his portfolio stocks fall steeply after the announcement is made. Now, what RBI will eventually decide and who makes money is not our concern. The point is to identify who is a speculator, a trader, and an investor based on their thought process. All the 3 men seemed to have logic based on which they have taken a market action. Please note, Gurush's decision to do nothing itself is a market action. Sunil seems to be highly certain on what RBI is likely to do and therefore his market actions are oriented towards a rate cut. In reality, it is quite impossible to call a shot on what RBI, or for that matter any regulator, will do. These are complex matters and not straightforward to analyze. Betting on blind faith, without a rational reasoning backing one's decision, is speculation. Sunil seems to have done just that. Tarun has arrived at what needs to be done based on a plan. If you are familiar with options, he is simply setting up a trade to take advantage of the high options premium. He is clearly not speculating on what RBI is likely to do as it does not matter to him. His view is simple: volatility is high. Hence the premiums are attractive for an options seller. He is expecting the volatility to drop just prior to RBI decision. Is he speculating on the fact that the volatility will drop? Not really, because he seems to have backtested his strategy for similar scenarios in the past. A trader designs all his trades and not just speculates on an outcome. Gurush. The investor, on the other hand, seems to be least bit worked up on what RBI is expected to do. He sees this as a short-term market noise which may not have any major impact on his portfolio. Even if it did have an impact, he is of the opinion that his portfolio will eventually recover from it. Time is the only luxury markets offer, and Gurush is keen on leveraging this luxury to the maximum. In fact, he is even prepared to buy more of his portfolio stocks in case the market overreacts. His idea is to hold on to his positions for a long period of time and not get swayed by short-term market movements. All the 3 of them have different mindsets which leads them to react differently to the same situation. The focus of this chapter is to understand why Gurush, the investor, has a long-term perspective and not really bothered about short-term movements in the market. 2.2 The compounding effect. To appreciate why Gurush decided to stay invested and not really react to short-term market movement, one has to understand how money compounds. Compounding in simple terms is the ability of money to grow when the gains of year 1 is reinvested for year 2. For example, consider you invest 100 rupees which is expected to grow at 20% year on year. Recall this. is also called the CAGR. At the end of the first year, the money is expected to grow to 120 rupees. At the end of year 1, you have two options. Let 20 rupees in profits remain invested along with the original principal of 100 rupees, or withdraw the profits of 20 rupees. You decide not withdraw 20 rupees profit. Instead, you decide to reinvest the money for the second year. At the end of second year, 120 rupees grows to 144 rupees. At the end of third year, 144 rupees grows to 173 rupees. So on and so forth. Compare this with withdrawing 20 rupees profits every year. Had you opted to withdraw 20 rupees every year, then at the end of third year the profits would have been just Rs. 60. However, since you decided to stay invested, the profits at the end of 3 years is 173 rupees. A good 13 rupees or 21.7% over 60 rupees is generated just because you opted to do nothing and decided to stay invested. This is called the compounding effect. Let us take this analysis a little further. Have a look at the chart below. The chart above shows how 100 rupees invested at 20% grows over a 10-year period. If you notice, it took almost 6 years for the money to grow from 100 rupees to 300 rupees. However, the next 300 rupees was generated in only 4 years, i.e. from the 6th to 10th year. This is in fact the most interesting property of the compounding effect. The longer you stay invested, the harder and faster the money works for you. This is exactly why Girish decided to stay invested, to exploit the luxury of time that the market offers. All investments made based on fundamental analysis require the investors to stay committed for the long term. The investor has to develop this mindset while he chooses to invest. 2.3 Does investing work? Think about a sapling. If you give it the right amount of water, manure, and care, would it not grow? Of course it will. Likewise, think about a good business with healthy sales, great margins, innovative products, and an ethical management. Is it not obvious that the share price of such companies would appreciate? In some situations, the price appreciation may delay. Recall the Eicher Motors chart from previous chapter. But it certainly will always appreciate. This has happened over and over again across markets in the world, including India. An investment in a good company defined by investable grade attributes will always yield results. However, one has to develop the appetite to digest short-term market volatility. 2.4 Investable grade attributes. What does that mean? Like we discussed briefly in the previous chapter, an investable grade company has a few distinguishable characteristics. These characteristics can be classified under two heads, namely the qualitative aspect and the quantitative aspects. The process of evaluating a fundamentally strong company includes a study of both these aspects. In fact, in my personal investment practice, I give the qualitative aspects a little more importance over the quantitative aspects. The qualitative aspect mainly involves understanding the non-numeric aspects of the business. This includes many factors such as management's background, who are they, their background, experience, education, do they have the merit to run the business, any criminal cases against the promoters, etc. Business ethics, is the management involved in scams, bribery, unfair business practices, corporate governance, appointment of directors, organization structure, transparency, etc. Minority shareholders, how does the management treat minority shareholders? Do they consider their interest while taking corporate actions? Share transactions, is the management buying, selling shares of the company through clandestine promoter groups? Related party transactions, is the company tendering financial favors to known entities such as promoters, relatives, friends, vendors, etc. at the cost of the shareholders' funds? Salaries paid to promoters, is the management paying themselves a hefty salary, usually a percentage of profits? Operator activity in stocks, does the stock price display unusual price behavior, especially at a time when the promoter is transacting in the shares? Shareholders, who are the significant shareholders in the firm? Who are the people with above 1% of the outstanding shares of the company? Political affiliation. Is the company or its promoters too close to a political party? Does the business require constant political support? Promoter lifestyle. Are the promoters too flamboyant and loud about their lifestyle? Do they like to display their wealth? A red flag is raised when any of the factors mentioned above do not fall in the right place. For example, if a company undertakes too many related party transactions, then it would send a signal of favoritism and malpractice by the company. This is not good in the long run. So even if the company has great profit margins, malpractice is not acceptable. It would only be a matter of time before the market discovers matters pertaining to related party transactions and punishes the company by bringing the stock price lower. Hence, an investor would be better off not investing in companies with great margins if such a company scores low on corporate governance. Qualitative aspects are not easy to uncover because these are very subtle matters. However, a diligent investor can easily figure this out by paying attention to annual report, management interviews, news reports, etc. As we proceed through this module, we will highlight various qualitative aspects. The quantitative aspects are matters related to financial numbers. Some of the quantitative aspects are straightforward while some of them are not. For example, cash held in inventory is straightforward, however, inventory number of days is not. This is a metric that needs to be calculated. The stock markets pay a lot of attention to quantitative aspects. Quantitative aspects include many things. To name few: profitability and its growth, margins and its growth, earnings and its growth, matters related to expenses, operating efficiency, pricing power, matters related to taxes, dividends payout, cash flow from various activities, debt, both short-term and long-term, working capital management, asset growth, investments, financial ratios. The list is virtually endless. In fact, each sector has different metrics. For example, for a retail industry, for an oil and gas industry, total number of stores, average sales per store, total sales per square foot, merchandise margins, owned store to franchisee ratio, oil to natural gas revenue ratio, exploration costs, opening oil balance inventory, developed reserves, total production growth. Over the next few chapters, we will understand how to read the basic financial statements as published in the annual report. As you may know, the financial statement is the source for all the number crunching as required in the analysis of quantitative aspects. Key takeaways from this chapter. The mindset of a trader and an investor is different. The investor has to develop an investment mindset if he is serious about investing. The investor should stay invested for a long period of time for the returns to compound. The speed at which the money doubles increases drastically the more time you stay invested. This is one of the properties of compounding. Every investment has to be evaluated on two aspects, qualitative and quantitative. Qualitative aspects revolve around the non-numeric information related to the company. The quantitative aspects involve analyzing numeric data. The financial statements are the important source of finding the quantitative data. 36 responses to key takeaways from this chapter. The mindset of a trader and an investor is different. The investor has to develop an investment mindset if he is serious about investing. The investor should stay invested for a long period of time for the returns to compound. The speed at which the money doubles increases drastically the more time you stay invested. This is one of the properties of compounding. Every investment has to be evaluated on two aspects, qualitative and quantitative. Qualitative aspects revolve around the non-numeric information related to the company. The quantitative aspects involve analyzing numeric data. The financial statements are the important source of finding the quantitative data. Please select desired text on the website first. You can also select text, then right-click on it. Open a ZERODHA account. Chapter 3. How to read the annual report of a company. 3.1 What is an annual report? The annual report is a yearly publication by the company and is sent to the shareholders and other interested parties. The annual report is published by the end of the financial year, and all the data made available in the annual report is dated to the 31st of March. The R is usually available on the company's website in the Investors section as a PDF document, or one can contact the company to get a hard copy of the same. Since the annual report is published by the company, whatever is mentioned in the R is assumed to be official. Hence, any misrepresentation of facts in the annual report can be held against the company. To give you a perspective, R contains the auditor's certificates, signed, dated, and sealed, certifying the sanctity of the financial data included in the annual report. Potential investors and the present shareholders are the primary audience for the annual report. Annual reports should provide the most pertinent information to an investor and should also communicate the company's primary message. For an investor, the annual report must be the default option to seek information about a company. Of course, there are many media websites claiming to give the financial information about the company. However, the investors should avoid seeking information from such sources. Remember, the information is more reliable if we get it directly from the annual report. Why would the media website misrepresent the company information, you may ask? Well, they may not do it deliberately, but they may be forced to do it due to other factors. For example, the company may like to include depreciation in the expense side of P&L, but the media website may like to include it under a separate header. While this would not impact the overall numbers, it does interrupt the overall sequencing of data. 3.2 What to look for in an annual report. The annual report has many sections that contain useful information about the company. One has to be careful while going through the annual report, as there is a very thin line between the facts presented by the company and the marketing content that the company wants you to read. Let us briefly go through the various sections of an annual report and understand what the company is trying to communicate in the R. For the sake of illustration, I have taken the annual report of Amara Raja Batteries Limited, belonging to financial year 2013-2014. As you may know, Amara Raja Batteries Limited manufactures automobile and industrial batteries. You can download ARBL's FY2014R from here. http://www.amararaja.co.in/annual_reports.asp closing parenthesis. Please remember, the objective of this chapter is to give you a brief orientation on how to read an annual report. Running through each and every page of an R is not practical. However, I would like to share some insights into how I would personally read through an R, and also help you understand what kind of information is required and what information we can ignore. For a better understanding, I would urge you to download the annual report of ARBL and go through it simultaneously as we progress through this chapter. ARBL's annual report contains the following 9 sections. Financial highlights, the management statement, management discussion and analysis, 10-year financial highlights, corporate information, director's report, report on corporate governance, financial section, and notice. Note: no two annual reports are the same. They are all made to suit the company's requirement, keeping in perspective the industry they operate in. However, some of the sections in the annual report are common across annual reports. The first section in ARBL's R is the financial highlights. Financial highlights contains the bird's eye view on how the financials of the company looks for the year gone by. The information in this section can be in the form of a table or a graphical display of data. This section of the annual report generally does a multi-year comparison of the operating and business metrics. Here is the snapshot of the same. The details that you see in the financial highlights section are basically an extract from the company's financial statement, along with the extracts. The company can also include a few financial ratios, which are calculated by the company itself. I briefly look through this section to get an overall idea. but I do not like to spend too much time on it. The reason for looking at this section briefly is that I would anyway calculate these and many other ratios myself, and while I do so, I would gain greater clarity on the company and its numbers. Needless to say, over the next few chapters we will understand how to read and understand the financial statements of the company and also how to calculate the financial ratios. The next two sections, i.e. the management statement and management discussion and analysis, are quite important. I spend time going through these sections. Both these sections gives you a sense on what the management of the company has to say about their business and the industry in general. As an investor or as a potential investor in the company, every word mentioned in these sections is important. In fact, some of the details related to the qualitative aspects, as discussed in Chapter 2, can be found in these two sections of the R. In the management statement, sometimes called the chairman's message, the investor gets a perspective of how the man sitting right on top is thinking about his business. The content here is usually broad-based and gives a sense on how the business is positioned. When I read through this section, I look at how realistic the management is. I am very keen to see if the company's management has its feet on the ground. I'd also observe if they are transparent on discussing details on what went right and what went wrong for the business. One example that I explicitly remember was reading through the chairman's message of a well-established tea manufacturing company. In his message, the chairman was talking about a revenue growth of nearly 10%. However, the historical revenue numbers suggested that the company's revenue was growing at a rate of 4 to 5%. Clearly, in this context, the growth rate of 10% seemed like a celestial move. This also indicated to me that the man on top may not really be in sync with ground reality, and hence I decided not to invest in the company. Retrospectively, when I look back at my decision not to invest, it was probably the right decision. Here is the snapshot of Amara Raja Batteries Limited. I have highlighted a small part that I think is interesting. I would encourage you to read through the entire message in the annual report. Moving ahead. The next section is the Management Discussion and Analysis, or MD&A. This, according to me, is perhaps one of the most important sections in the whole of R. The most standard way for any company to start this section is by talking about the macro trends in the economy. They discuss the overall economic activity of the country and the business sentiment across the corporate world. If the company has high exposure to exports, they even talk about global economic and business sentiment. ARBL has both exports and domestic business interest. Hence they discuss both these angles in their R. See the snapshot below. ARBL's view on the Indian economy. Following this, the companies usually talk about the trends in the industry and what they expect for the year ahead. This is an important section as we can understand what the company perceives as threats and opportunities in the industry. Most importantly, I read through this and also compare it with its peers to understand if the company has any advantage over its peers. For example, if Amara Raja Batteries Limited is a company of interest to me, I would read through this part of the R and also would read through what Exide Batteries Limited has to say in their R. Remember, until this point, the discussion in the management discussion and analysis is broad-based and generic: global economy, domestic economy, and industry trends. However, going forward, the company would discuss various aspects related to its business. It talks about how the business had performed across various divisions. How did it fare in comparison to the previous year, etc. The company in fact gives out specific numbers in this section. Here is a snapshot of the same. Some companies even discuss their guidelines and strategies for the year ahead across the various verticals they operate in. Do have a look at the snapshot below. After discussing these in management discussion and analysis, the annual report includes a series of other reports such as Human Resources Report, R&D report, technology report, etc. Each of these reports are important in the context of the industry the company operates in. For example, if I am reading through a manufacturing company annual report, I would be particularly interested in the Human Resources report to understand if the company has any labor issues. If there are serious signs of labor issues, then it could potentially lead to the factory being shut down, which is not good for the company's shareholders. 3.3 The financial statements. Finally, the last section of the ARC contains the financial statements of the company. As you would agree, the financial statements are perhaps one of the most important aspects of an annual report. There are 3 financial statements that the company will present, namely, the profit and loss statement, the balance sheet, and the cash flow statement. We will understand each of these statements in detail over the next few chapters. However, at this stage it is important to understand that the financial statements come in 2 forms: standalone financial statement, or simply standalone numbers, and consolidated financial statement, or simply consolidated numbers. To understand the difference between standalone and consolidated numbers, we need to understand the structure of a company. Typically, a well-established company has many subsidiaries. These companies also act as a holding company for several other well-established companies. To help you understand this better, I have taken the example of CRISIL Limited's shareholding structure. You can find the same in CRISIL's annual report. As you may know, CRISIL is an Indian company with a major focus on corporate credit rating services. As you can see in the above shareholding structure, Standard & Poor's (S&P), a US-based rating agency, holds a 51% stake in CRISIL. Hence, S&P is the holding company, or the promoter, of CRISIL. The balance 49% of shares of CRISIL is held by public and other financial institutions. However, S&P itself is 100% subsidiary of another company called the McGraw-Hill Companies. This means McGraw-Hill fully owns S&P, and S&P owns 51% of CRISIL. Further, CRISIL itself fully owns 100% shareholding another company called IREVNA. Keeping the above in perspective, think about this hypothetical situation. Assume, for the financial year 2014, CRISIL makes a loss of 1,000 rupees CRS and IREVNA, its 100% subsidiary, makes a profit of 700 rupees CRS. What would be the overall profitability of CRISIL? Well, this is quite simple. CRISIL on its own made a loss of 1,000 rupees CRS, but its subsidiary IREVNA made a profit of 700 rupees CRS. Hence, the overall P&L of CRISIL is 1,000 rupees CRS plus 700 rupees CRS equals 300 rupees CRS. Thanks to its subsidiary, CRISIL's loss is reduced to 300 rupees CRS as opposed to a massive loss of 1,000 rupees CRS. Another way to look at it is, CRISIL on a standalone basis made a loss of 1,000 rupees CRS, but on a consolidated basis made a loss of 300 rupees CRS. Hence, standalone financial statements represent the standalone numbers, financials of the company itself, and do not include the financials of its subsidiaries. However, the consolidated numbers includes the company's standalone financials and its subsidiaries' financial statements. I personally prefer to look through the consolidated financial statements as it gives a better representation of the company's financial position. 3.4 Schedules of financial statements. When the company reports its financial statements, they usually report the full statement in the beginning and then follow it up with a detailed explanation. Have a look at the snapshot of one of ARBL's financial statement balance sheet. Each particular in the financial statement is referred to as the line item. For example, the first line item in the balance sheet under equity and liability is the share capital, as pointed out by the green arrow. If you notice, there is a note number associated with share capital. These are called the schedules related to the financial statement. Looking into the above statement, ARBL states that the share capital stands at 17 rupees 0.081 CRS or 170.81 million rupees. As an investor, I'd obviously would be interested to know how ARBL arrived at 17 rupees 0.081 CRS as their share capital. To figure this out, one needs to look into the associated schedule, note number 2. Please look at the snapshot below. Of course, considering you may be new to financial statements, jargons like share capital may not make much sense. However, the financial statements are extremely simple to understand. And over the next few chapters you will understand how to read the financial statements and make sense of it. But for now, do remember that the main financial statement gives you the summary and the associated schedules give the details pertaining to each line item. Key takeaways from this chapter. The annual report (R) of a company is an official communication from the company to its investors and other stakeholders. The R is the best source to get information about the company. Hence, R should be the default choice for the investor to source company-related information. The R contains many sections, with each section highlighting certain aspect of the business. The R is also the best source to get information related to the qualitative aspects of the company. The management discussion and analysis is one of the most important sections in the R. It has the management's perspective on the overall economy of the country, their outlook on the industry they operate in for the year gone by, what went right and what went wrong, and what they foresee for the year ahead. The R contains 3 financial statements: profit and loss statement, balance sheet, and cash flow statement. The standalone statement contains the financial numbers of only the company in consideration. However, the consolidated numbers contains the company and its subsidiaries' financial numbers. 51 responses to Open a ZERODHA account. Chapter 4. Understanding the P&L Statement, Part 1. 4.1 Overview of the financial statements. You can think about the financial statements from 2 different angles. From the maker's perspective, from the user's perspective. A maker prepares the financial statements. He is typically a person with an accounting background. His job involves preparing ledger entries, matching bills and receipts, tallying the inflows versus the outflows, auditing, etc. The final objective of the is to prepare transparent financial statements which best represents the true financial position of the company. To prepare such a financial statement, certain skills are required. Usually these skills are developed through the rigor of a chartered accountant's training program. The user, on the other hand, just needs to be in a position to understand what the maker has prepared. He is just the user of the financial statements. He need not really know the details of the journal entries or the audit procedure. His main concern is to read what is being stated and use it to make his decisions. To put this in context, think about Google. Most of us do not understand Google's complex search engine algorithm that runs in the back end. However, we all know how to use Google effectively. Such is the distinction between the maker and the user of financial statements. A common misconception amongst the market participants is that they believe the fundamental analyst needs to be thorough with concepts of financial statement preparation. While knowing this certainly helps, it is not really required. To be a fundamental analyst, one just needs to be the user and not the maker of the financial statements. There are 3 main financial statements that a company showcases to represent its performance: the profit and loss statement, the balance sheet, the cash flow statement. Over the next few chapters we will understand each of these statements from the user's perspective. 4.2 The profit and loss statement. The profit and loss statement is also popularly referred to as the P&L statement, income statement, statement of operations, and statement of earnings. The profit and loss statement shows what has transpired during a time period. The P&L statement reports information on the revenue of the company for the given period, yearly or quarterly, the expenses incurred to generate the revenues, tax and depreciation, the earnings per share number. From my experience, the financial statements are best understood by looking at the actual statement and figuring out the information. Hence, here is the P&L statement of Amara Raja Batteries Limited, AARBL. Let us understand each and every line item. 4.3 The top line of the company, revenue. You may have heard analysts talk about the top line of a company. When they do so, they are referring to the revenue side of the P&L statement. The revenue side is the first set of numbers the company presents in the P&L. Before we start understanding the revenue side, let us notice a few things mentioned on the header of the P&L statement. The header clearly states, the statement of P&L for the year ending March 31st, 2014. Hence this is an annual statement and not a quarterly statement. Also, since it is as of March 31st, 2014, it is evident that the statement is for the financial year 2013. 2014, or simply it can be referred to as the FY14 numbers. All currency is denominated in rupee million. Note 1 million rupees is equal to 10 lakh rupees. It is up to the company's discretion to decide which unit they would prefer to express their numbers in. The particulars show all the main headings of the statement. Any associated note to the particulars is present in the notes section, also called the schedule. An associated number is assigned to the note number. By default, when companies report the numbers in the financial statement, they present the current year number on the leftmost column and the previous year number to the right. In this case, the numbers are for FY14, latest, and FY13, previous. The first line item on the revenue side is called the sale of products. Since we know we are dealing with a batteries company, clearly sale of products means the rupee value of all the battery sales the company has sold during FY14. The sales stand at 38,041,270,000 rupees per, or about 3,804 crore rupees. The company sold batteries worth 3,294 crore rupees in the previous financial year, i.e. FY13. Please note, I will restate all the numbers in rupee crore as I believe this is more intuitive to understand. The next line item is the excise duty. This is the amount, 400 rupees CRS, the company would pay to the government. Hence the revenue has to be adjusted. The revenue adjusted after the excise duty is the net sales of the company. The net sales of ARBL is 3,403 rupees CRS for FY14. The same was 2,943 rupees CRS for FY13. Apart from the sale of products, the company also draws revenue from services. This could probably be in the form of annual battery maintenance. The revenue from sale of services stands at 30 rupees and 90 paise CRS for FY14. The company also includes other operating revenues at 2 rupees and 10 paise CRS. This could be revenues through the sale of products or services that is incidental to the core operations of the company. Finally, the revenue from sale of products plus sale of services plus other operating revenues sums up to give the total operating revenue of the company. This is reported at 3,436 rupees CRS for FY14 and 2,959 rupees CRS for FY13. Interesting. There is a note numbered 17 associated with net revenue from operations, which will help us inspect this aspect further. Do recall, in the previous chapter we had discussed about notes and schedules of the financial statement. The following snapshot gives the details of note 17. Clearly, the notes give a more detailed analysis of the split up of revenues from operations, does not include other income details. As you can see under the particulars, Section A talks about the split up under sales of products. Sale of storage batteries in the form of finished goods for the year FY14 is 3,523 rupees CRS versus 3,036 rupees CRS in FY13. Sale of storage batteries, stock and trade, is 208 rupees CRS in FY14 versus 149 CRS. Stock and trade refers to finished goods of previous financial year being sold in this financial year. Sale of home UPS stock in goods is at 71 rupees CRS in FY14 versus 109 rupees CRS FY13. Net sales from sales of products adjusted for excise duty amounts to 3,403 rupees CRS, which matches with the number reported in the P&L statement. Likewise, you can notice the split up for revenue from services. The revenue number of 30 rupees and 90 paise tallies with number reported in the P&L statement. In the note, the company says the sale of processed scrap generated revenue of 2.1 crore rupees. Note that the sale of processed scrap is incidental to the operations of the company, hence reported as other operating revenue. Adding up all the revenue streams of the company, i.e. 3,403 rupees CRS plus 30 rupees and 90 paise CRS plus 2 rupees and 10 paise CRS gets us the net revenue from operations equals 3,436 rupees CRS. You can also find similar split up for FY13. If you notice the P&L statement, apart from net revenue from operations, ARBL also reports other income of 45 rupees and 50 paise CRS. Note number 18 reproduced below explains what the other income is all about. As we can see, the other income includes income that is not related to the main business of the company. It includes interest on bank deposits, dividends, insurance claims, royalty income, etc. Usually the other income forms, and it should, a small portion of the total income. A large other income usually draws a red flag and it would demand a further investigation. So adding up revenue from operations 3,436 rupees CRS and other income 45 rupees CRS, we have the total revenue for FY14 at 3,482 rupees CRS. Key takeaways from this chapter. The financial statement provides information and conveys the financial position of the company. A complete set of financial statements include the profit and loss account, balance sheet and cash flow statement. A fundamental analyst is a user of financial statement, and he just needs to know what the maker of the financial statement states. The profit and loss statement gives the profitability of the company for the year under consideration. The P&L statement is an estimate, as the company can revise the numbers at a later point. Also, by default, companies publish data for the current year and the previous year, side by side. The revenue side of the P&L is also called the top line of the company. Revenue from operations is the main source of revenue for the company. Other operating income includes revenue incidental to the business. The other income includes revenue from non-operating sources. The sum of revenue from operations, net of duty, other operating income, and other incomes gives the net revenue from operations. 41 responses to understanding the P. Open a ZERODHA account. Chapter 5. Understanding P&L Statement Part 2. 5.1 The expense details. In the previous chapter we had learned about the revenues a company generates. Moving further on the P&L statement. In this chapter we will look at the expense side of the profit and loss statement along with the associated notes. Expenses are generally classified according to their function, which is also called the cost of sales method, or based on the nature of expense. An analysis of the expenses must be shown in the profit and loss statement or in the notes. As you can see in the extract below, almost all the line items have a note associated to it. The first line item on the expense side is cost of materials consumed. This is invariably the cost of raw material that the company requires to manufacture finished goods. As you can see, the cost of raw material consumed, raw material is the largest expense incurred by the company. This expense stands at 2,101 rupees CRS for the FY14 and 1,760 rupees CRS for the FY13. Note number 19 gives the associated details for this expense. Let us inspect the same. As you can see, note 19 gives us the details of the material consumed. The company uses lead alloys, separators and other items, all of which adds up to 2,101 rupees CRS. The next two line items talks about purchases of stock in trade and change in inventories of finished goods, work in process and stock in trade. Both these line items are associated with the same note, note 20. Purchases of stock in trade. refers to all the purchases of finished goods that the company buys towards conducting its business. This stands at 211 rupees CRS. I will give you more clarity on this line item shortly. Change in inventory of finished goods refers to the costs of manufacturing incurred by the company in the past, but the goods manufactured in the past were sold in the current financial year. This stands at 29 rupees and 20 paise CRS for the FY14. A negative number indicates that the company produced more batteries in the FY14 than it managed to sell. To give a sense of proportion in terms of sales and costs of sales, the company deducts the cost incurred in manufacturing the extra goods from the current year costs. The company will add this cost when they manage to sell these extra products sometime in future. This cost, which the company adds back later, will be included in the purchases of stock in trade line item. Here is an extract of Note 20 which details the above two line items. The details mentioned on the above extract are quite straightforward and is easy to understand. At this stage it may not be necessary to dig deeper into this note. It is good to know where the grand total lies. However, when we take up financial modeling as a separate module, we will delve deeper into this aspect. The next line item on the expense side is employee benefit expense. This is quite intuitive as it includes expense incurred in terms of the salaries paid, contribution towards provident funds, and other employee welfare expenses. This stands at 158 rupees CRS for the FY14. Have a look at the extract of Note 21 which details the employee benefit expense. Here is something for you to think about. A company generating 3,482 rupees CRS is spending only 158 rupees CRS or just 4.5% of its sales on its employees. In fact, this is the pattern across most of companies, at least non-IT. Perhaps it is time for you to rethink about that entrepreneurial dream you may have nurtured. The next line item is the finance cost, finance charges, borrowing costs. Finance cost is interest costs and other costs that an entity pays when it borrows funds. The interest is paid to the lenders of the company. The lenders could be banks or private lenders. The company's finance cost stands at 70 paise CRS for the FY14. We will discuss more about the debt and related matters when we take the chapter on the balance sheet later. Following the finance cost, the next line item is depreciation and amortization costs which stand at 64 rupees and 50 paise CRS. To understand depreciation and amortization, we need to understand the concept of tangible and intangible assets. A tangible asset is one which has a physical form and provides an economic value to the company. For example, a laptop, a printer, a car, plants, machinery, buildings, etc. An intangible asset is something that does not have a physical form but still provides an economic value to the company, such as brand value, trademarks, copyrights, patents, franchises, customer lists, etc. An asset, tangible or intangible, has to be depreciated over its useful life. Useful life is defined as the period during which the asset can provide economic benefit to the company. For example, the useful life of a laptop could be 4 years. Let us understand depreciation better with the help of the following example. Zerodha. A stock-broking firm generates 100,000 rupees per from the stock-broking business. However, Zerodha incurred an expense of 65,000 rupees per towards the purchase of a high-performance computer server. The economic useful life of the server is expected to be 5 years. Now if you were to look into the earning capability of Zerodha, it appears that on one hand Zerodha earned 100,000 rupees per and on the other hand spent 65,000 rupees per and therefore retained just 35,000 rupees per. This skews the earnings data for the current year and does not really reflect the true earning capability of the company. Remember, the asset, even though purchased this year, would continue to provide economic benefits over its useful life. Hence, it makes sense to spread the cost of acquiring the asset over its useful life. This is called depreciation. This means instead of showing an upfront lump sum expense towards purchase of an asset, the company can show a smaller amount spread across the useful life of an ASO. Thus 65,000 rupees per will be spread across the useful life of the server, which is 5. Hence 65,000 fifths equals 13,000 rupees per would be depreciated every year over the next 5 years. By depreciating the asset, we are spreading the upfront cost. Hence after the depreciation computation, Zerodha would now show its earnings as 100,000 rupees. 13,000 rupees equals 87,000 rupees per. We can do a similar exercise for non-tangible assets. The depreciation equivalent for non-tangible assets is called amortization. Now here is an important idea. Zerodha depreciates the cost of acquiring an asset over its useful life. However, in reality there is an actual outflow of 65,000 rupees per paid towards the asset purchase. But now, it seems like the P&L is not capturing this outflow. As an analyst, how do we get a sense of the cash movement? Well, the cash movement is captured in the cash flow statement, which we will understand in the later chapters. Here is the snapshot of note 23, detailing the depreciation cost. The last line item on the expense side is other expenses at 434 rupees and 60 paise CRS. This is a huge amount classified under other expenses. Hence, it deserves a detailed inspection. From the note it is quite clear that other expenses include manufacturing, selling, administrative and other expenses. The details are mentioned in the note. For example, Amara Raja Batteries Limited (ARBL) spent 27 rupees and 50 paise CRS on advertisement and promotional activities. Adding up all the expenses mentioned in the expense side of P&L, it seems that Amara Raja Batteries has spent 2,941 rupees and 60 paise CRS. 5.2 The profit before tax. It refers to the net operating income after deducting operating expenses but before deducting taxes and interest. Proceeding further on the P&L statement, we can see that ARBL has mentioned their profit before tax and exceptional item numbers. Simply put, the profit before tax (PBT) is profit before tax equals total revenues, total operating expenses equals 3,482 rupees, 2,941 rupees and 60 paise equals 540 rupees and 50 paise. However, there seems to be an exceptional item, extraordinary item of 3 rupees and 80 paise CRS, which needs to be deducted. Exceptional items, extraordinary items are expenses occurring at one odd time for the company and the company does not foresee this as a recurring expense. Hence they treat it separately on the P&L statement. Hence profit before tax and extraordinary items will be equals 540.5 to 3.88. Equals 536 rupees and 60 paise CRS. The snapshot below, extract from P&L, shows the PBT, profit before tax, of ARBL. 5.3 Net profit after tax. The net operating profit after tax is defined as the company's operating profit after deducting its tax liability. We are now looking into the last part of the P&L statement, which is the profit after tax. This is also called the bottom line of the P&L statement. As you can see from the snapshot above, to arrive at the profit after tax (PAT), we need to deduct all the applicable tax expenses from the PBT. Current tax is the corporate tax applicable for the given year. This stands at 158 rupees CRS. Besides this, there are other taxes that the company has paid. All taxes together total up to 169 rupees and 21 paise CRS. Deducting the tax amount from the PBT of 536 rupees and 60 paise gives us the profit after tax (PAT) at 367 rupees and 40 paise CRS. Hence net PAT equals PBT, applicable taxes. The last line in the P&L statement talks about basic and diluted earnings per share. The EPS is one of the most frequently used statistics in financial analysis. EPS also serves as a means to assess the stewardship and management role performed by the company, directors and managers. The earnings per share (EPS) is a very sacred number which indicates how much the company is earning per face value of the ordinary share. It appears that ARBL is earning 21 rupees and 51 paise per share. The detailed calculation is as shown below. The company indicates that there are 12,500 shares outstanding in the market. Dividing the total profit after tax number by the outstanding number of shares, we can arrive at the earnings per share number. In this case, 367 rupees and 40 paise CRS divided by 12,500 yields 21 rupees and 50 paise per share. 5.4 Conclusion. Now that we have gone through all the line items in the P&L statement, let us relook at it in its entirety. Hopefully, the statement above should look more meaningful to you by now. Remember, almost all line items in the P&L statement will have an associated note. You can always look into the notes to seek greater clarity. Also, at this stage we have just understood how to read the P&L statement, but we still need to analyze what the numbers mean. We will do this when we take up the financial ratios. Also, the P&L statement is very closely connected with the other two financial statements, i.e. the balance sheet and the cash flow statement. We will explore these connections at a later stage. Key takeaways from this chapter. The expense part of the P&L statement contains information on all the expenses incurred by the company during the financial year. Each expense can be studied with reference to a note which you can explore for further information. Depreciation and amortization is a way of spreading the cost of an asset over its useful life. Finance cost is the cost of interest and other charges paid when the company borrows money for its capital expenditure. PBT equals total revenue, total expense, exceptional items, if any. Net PAT equals PBT, applicable taxes. EPS reflects the earning capacity of a company on a per-share basis. Earnings are profit after tax and preferred dividends. EPS equals PAT, total number of outstanding ordinary shares. 89 Response. Open a ZERODHA account. Chapter 6. Understanding Balance Sheet Statement, Part 1. 6.1 The Balance Sheet Equation. While the P&L statement gives us information pertaining to the profitability of the company, the balance sheet gives us information pertaining to the assets, liabilities, and the shareholders' equity. The P&L statement, as you understood, discusses about the profitability for the financial year under consideration. Hence, it is good to say that the P&L statement is a standalone statement. The balance sheet, however, is prepared on a flow basis, meaning it has financial information pertaining to the company right from the time it was incorporated. Thus, while the P&L talks about how the company performed in a particular financial year, the balance sheet, on the other hand, discusses how the company has evolved financially over the years. Have a look at the balance sheet of Amara Raja Batteries Limited, AARBL. As you can see, the balance sheet contains details about the assets, liabilities, and equity. We had discussed about assets in the previous chapter. Assets, both tangible and intangible, are owned by the company. An asset is a resource controlled by the company and is expected to have an economic value in the future. Typical examples of assets include plants, machinery, cash, brands, patents, etc. Assets are of two types: current and non-current. We will discuss these later in the chapter. Liability, on the other hand, represents the company's obligation. The obligation is taken up by the company because the company believes these obligations will provide economic value in the long run. Liability, in simple words, is the loan that the company has taken and it is therefore obligated to repay back. Typical examples of obligation include short-term borrowing, long-term borrowing, payments due, etc. Liabilities are of two types, namely current and non-current. We will discuss about the kinds of liabilities later on in the chapter. In any typical balance sheet, the total assets of company should be equal to the total liabilities of the company. Hence, assets equals liabilities. The equation above is called the balance sheet equation or the accounting equation. In fact, this equation depicts the key property of the balance sheet, i.e. the balance sheet should always be balanced. In other words, the assets of the company should be equal to the liabilities of the company. This is because everything that a company owns, assets, has to be purchased either from either the owner's capital or liabilities. Owner's capital is the difference between the assets and liabilities. It is also called the shareholder's equity or the net worth, representing this in the form of an equation. Shareholders' equity equals assets, liabilities. 6.2a Quick note on shareholders' funds. As we know, the balance sheet has two main sections, i.e., the assets and the liabilities. The liabilities, as you know, represent the obligation of the company. The shareholders' fund, which is integral to the liabilities side of the balance sheet, is highlighted in the snapshot below. Many people find this term a little confusing. If you think about it, on one hand we are discussing about liabilities which represent the obligation of the company. And on the other hand we are discussing the shareholders' fund which represents the shareholders' wealth. This is quite counterintuitive, isn't it? How can liabilities and shareholders' funds appear on the liabilities side of balance sheet? After all, the shareholders' funds represents the funds belonging to its shareholders, which in the true sense is an asset and not really a liability. To make sense of this, you should change the perspective in which you look at a company's financial statement. Think about the entire company as an individual, whose sole job is run its core operation and to create wealth to its shareholders. By thinking this way, you are in fact separating out the shareholders, which also includes its promoters and the company. With this new perspective, now think about the financial statement. You will appreciate that the financial statements is a statement published by the company, which is an entity on its own, to communicate to the world about its financial well-being. This also means the shareholders' funds do not belong to the company as it rightfully belongs to the company's shareholders. Hence, from the company's perspective, the shareholders' funds are an obligation payable to shareholders. Hence, this is shown on the liabilities side of the balance sheet. 6.3 The liabilities side of balance sheet. The liabilities side of the balance sheet details out all the liabilities of the company. Within liabilities there are three subsections: shareholders' fund, non-current liabilities, and current liabilities. The first section is the shareholders' funds. To understand share capital, think about a fictional company issuing shares for the first time. Imagine Company ABC issues 1,000 shares, with each share having a face value of 10 rupees each. The share capital in this case would be 10 rupees x 1,000 equals 10,000 rupees per face value x number of shares. In the case of ARBL, the share capital is 17 rupees 0.081 CRS as published in the balance sheet, and the face value is 1 rupee per. I got the FV value from the NSE's website. I can use the FV and share capital value to calculate the number of shares outstanding. We know share capital equals FV asterisk number of shares. Therefore, number of shares equals share capital FV. Hence, in case of ARBL, number of shares equals 1708 10,000 over 1 equals 1708 10,000 shares. The next line item on the liability side of the balance sheet is the reserves and surplus. Reserves are usually money earmarked by the company for specific purposes. Surplus is where all the profits of the company reside. The reserves and surplus for ARBL stands at 1,345 rupees and 60 paise CRS. The reserves and surplus have an associated note, numbered 3. Let us look into the same. As you can notice from the note, the company has earmarked funds across three kinds of reserves. Capital reserves, usually earmarked for long-term projects. Clearly, ARBL does not have much amount here. This amount belongs to the shareholders, but cannot be distributed to them. Securities premium reserve account. This is where the premium over and above the face par value of the shares sits. ARBL has a 31 rupees and 18 paise CRS under this reserve. General reserve. This is where all the accumulated profits of the company which is not yet distributed to the shareholder reside. The company can use the money here as a buffer. As you can see, ARBL has 218 rupees and 40 paise CRS in general reserves. The next section deals with the surplus. As mentioned earlier, surplus holds the profits made during the year. Couple of interesting things to note. As per the last year, FY13 balance sheet, the surplus was 829 rupees and 80 paise CRS. This is what is stated as the opening line under surplus. See the image below. The current year FY14 profit of 367 rupees and 40 paise CRS is added to previous year's closing balance of surplus. Few things to take note here. Notice how the bottom line of P&L is interacting with the balance sheet. This highlights a very important fact: all the three financial statements are closely related. Notice how the previous year balance sheet number is added up to this year's number. This highlights the fact that the balance sheet is prepared on a flow basis, adding the carrying forward numbers year on year. Previous year's balance plus this year's profit adds up to 1,197 rupees and 20 paise CRS. The company can choose to apportion this money for various purposes. The first thing a company does is it transfers some money from the surplus to general reserve so that it will come handy for future use. They have transferred close to 36 rupees and 70 paise CRS for this purpose. After transferring to general reserves, they have distributed 55 rupees and 10 paise CRS as dividends, over which they have to pay 9 rupees and 30 paise CRS as dividend distribution taxes. After making the necessary apportions, the company has 1,095 rupees and 90 paise CRS as surplus as closing balance. This, as you may have guessed, will be the opening balance for next year's FY15 surplus account. Total reserves and surplus equals capital reserve plus securities premium reserve plus general reserves plus surplus for the year. This stands at 1,345 rupees and 60 paise CRS for the FY14 against 1,042 rupees and 70 paise CRS for the FY13. The total shareholders' fund is a sum of share capital and reserves and surplus. Since this amount on the liability side of the balance sheet represents the money belonging to shareholders, this is called the shareholders' funds. 6.4 Non-current liabilities. Non-current liabilities represent the long-term obligations which the company intends to settle, pay off not within 365 days, 12 months of the balance sheet date. These obligations stay on the books for few years. Non-current liabilities are generally settled after 12 months after the reporting period. Here is the snapshot of the non-current liabilities of Amara Raja Batteries Limited. The company has 3 types of non-current liabilities. Let us inspect each one of them. The long-term borrowing associated with Note 4 is the first line item within the non-current liabilities. Long-term borrowing is one of the most important line item in the entire balance sheet, as it represents the amount of money that the company has borrowed through various sources. Long-term borrowing is also one of the key inputs while calculating some of the financial ratios. Subsequently, in this module, we will look into the financial ratios. Let us look into the note associated with long-term borrowings. From the note, it is quite clear that the long-term borrowings is in the form of interest-free sales tax deferment. To understand what interest-free sales tax deferment really means, the company has explained just below the note. I have highlighted the same in a red box. It appears to be some sort of tax incentive from the state government. The company plans to settle this amount over a period of 14 years. You will find that there are many companies which do not have long-term borrowings, debt. While it is good to know that the company has no debt, you must also question as to why there is no debt. Is it because the banks are refusing to lend to the company? Or is it because the company is not taking initiatives to expand their business operations? Of course, we will deal with the analysis part of the balance sheet later in the module. Do recollect, we looked at finance cost as a line item when we looked at the P&L statement. If the debt of the company is high, then the finance cost will also be high. The next line item within the non-current liability is deferred tax liability. The deferred tax liability is basically a provision for future tax payments. The company foresees a situation where it may have to pay additional taxes in the future. Hence, they set aside some funds for this purpose. Why do you think the company would put itself in a situation where it has to pay more taxes for the current year at some point in the future? Well, this happens because of the difference in the way depreciation is treated as per Companies Act and income tax. We will not get into this aspect as we will digress from our objective of becoming users of financial statements. But do remember, deferred tax liability arises due to the treatment of depreciation. The last line item within the non-current liability is the long-term provisions. Long-term provisions are usually money set aside for employee benefits such as gratuity, leave encashment, provident funds, etc. 6.5 Current liabilities. Current liabilities are a company's obligations which are expected to be settled within 365 days, less than 1 year. The term current is used to indicate that the obligation is going to be settled soon, within a year. Going by that, non-current clearly means obligations that extend beyond 365 days. Think about this way: if you buy a mobile phone on ME via a credit card, you obviously plan to repay your credit card company within a few months. This becomes your current liability. However, if you buy an apartment by seeking a 15-year home loan from a housing finance company, it becomes your non-current liability. Here is the snapshot of ARBL's current liabilities. As you can see, there are 4 line items within the current liabilities. The first one is the short-term borrowings. As the name suggests, these are short-term obligations of the company, usually undertaken by the company to meet day-to-day cash requirements, also called working capital requirements. Here is the extract of Note 7, which details what short-term borrowings mean. Clearly, as you can see, these are short-term loans availed from the State Bank of India and Andhra Bank towards meeting the working capital requirements. It is interesting to note that the short-term borrowing is also kept at low level, at just 8 rupees and 30 paise CRS. The next line item is trade payable, also called account payable, which is at 127 rupees and 70 paise CRS. These are obligations payable to vendors who supply to the company. The vendors could be raw material suppliers, utility companies providing services, stationery companies, etc. Have a look at Note 8, which gives the details. The next line item just says other current liabilities, which stands at 215 rupees and 60 paise CRS. Usually, other current liabilities are obligations associated with the statutory requirements and obligations that are not directly related to the operations of the company. Here is Note 9 associated with other current liabilities. The last line item in current liabilities is the short-term provisions, which stands at 281 rupees and 80 paise CRS. Short-term provisions is quite similar to long-term provisions, both of which details with setting aside funds for employee benefits such as gratuity, leave encashment, provident funds, etc. Interestingly, the note associated with short-term provisions and the long-term provisions is the same. Have a look at the following. Since Note 6 is detailing both long and short-term provisions, it runs into several pages. Hence, for this reason, I will not represent an extract of it. For those who are curious to look into the same can refer to pages 80, 81, 82 and 83 in the FY14 Annual Report for Amara Raja Batteries Limited. However, from the user of a financial statement perspective, all you need to know is that these line items, short and long-term provisions, deal with the employee and related benefits. Please note, one should always look at the associated note to run through the details. We have now looked through half of the balance sheet, which is broadly classified as the liabilities side of the balance sheet. Let us relook at the balance sheet once again to get a perspective. Clearly, total liability equals shareholders' funds plus non-current liabilities plus current liabilities equals 1,362.7 plus 143.03 plus 633.7. Total liability equals 2,139 rupees and 40 paise CRS. Key takeaways from this chapter. A balance sheet, also called the statement of financial position, is prepared on a flow basis which depicts the financial position of the company at any given point in time. It is a statement which shows what the company owns, assets, and what the company owes, liabilities. A business will generally need a balance sheet when it seeks investors, applies for loans, submits taxes, etc. Balance sheet equation is assets equals liabilities plus shareholders' equity. Liabilities are obligations or debts of a business from past transactions, and share capital is number of shares asterisk face value. Reserves are the funds earmarked for a specific purpose, which the company intends to use in future. Surplus is where the profits of the company reside. This is one of the points where the balance sheet and the P&L interact. Dividends are paid out of the surplus. Shareholders' equity equals share capital plus reserves plus surplus. Equity is the claim of the owners on the assets of the company. It represents the assets that remain after deducting the liabilities. If you rearrange the balance sheet equation, equity equals assets, liabilities. Non-current liabilities are the long-term liabilities, are obligations which are expected to be settled in not less than 365 days or 12 months of the balance sheet date. Deferred tax liabilities arise due to the discrepancy in the way that depreciation is treated. Deferred tax liabilities are amounts of income taxes payable in the future with respect to taxable differences as per accounting books and tax books. Current liabilities are the obligations the company plans to settle within 365 days, 12 months of the balance sheet date. In most cases, both long and short-term provisions are liabilities dealing with employee-related matters. Total liability equals shareholders' funds plus non-current liabilities plus current liabilities. Thus, total liabilities represent the total amount of money the company owes to others. 102 Response. Open a ZERODHA account. Chapter 7. Understanding the Balance Sheet Statement, Part 2. 7.1 The Asset Side of Balance Sheet. In the previous chapter we looked at the liability side of the balance sheet in detail. We will now proceed to understand the second half of the balance sheet, i.e. the asset side of the balance sheet. The asset side shows us all the assets the company owns in different forms right from its inception. Assets in simple terms are the resources held by a company, which help in generating the revenues. Here is the snapshot of the asset side of the balance sheet. As you can see, the asset side has two main sections, i.e. non-current assets and current assets. Both these sections have several line items with associated notes included within. We will look into each one of these line items. 7.2 Non-current assets, fixed assets. Similar to what we learned in the previous chapter, non-current assets talks about the assets that the company owns, the economic benefit of which is enjoyed over a long period beyond 365 days. Remember, an asset owned by a company is expected to give the company an economic benefit over its useful life. If you notice, within the non-current assets there is a subsection called fixed assets with many line items under it. Fixed assets are assets, both tangible and intangible, that the company owns which cannot be converted to cash easily or which cannot be liquidated easily. Typical examples of fixed assets are land, plant and machinery, vehicles, building, etc. Intangible assets are also considered fixed assets because they benefit companies over a long period of time. If you see, all the line items within fixed assets have a common note, numbered 10, which we will explore in great detail shortly. Here is the snapshot of fixed assets of Amara Raja Batteries Limited. The first line item, tangible assets, is valued at 619 rupees and 80 paise Rs. Tangible assets consists of assets which has a physical form. In other words, these assets can be seen or touched. This usually includes plant and machinery, vehicles, buildings, fixtures, etc. Likewise, the next line item reports the value of intangible assets valued at 3 rupees and 20 paise Rs. Intangible assets are assets which have an economic value, but do not have a physical nature. This usually includes patents, copyrights, trademarks, designs, etc. Remember, when we discussed the P&L statement, we discussed depreciation. Depreciation is a way of spreading the cost of acquiring the asset over its useful life. The value of the assets deplete over time. As the assets lose their productive capacity due to obsolescence and physical wear and tear. This value is called the depreciation expense, which is shown in the profit and loss account and the balance sheet. All the assets should be depreciated over its useful life. Keeping this in perspective, when the company acquires an asset, it is called the gross block. Depreciation should be deducted from the gross block, after which we can arrive at the net block. Net block equals gross block accumulated depreciation. Note: the term accumulated is used to indicate all the depreciation value since the incorporation of the company. When we read tangible assets at 619 rupees and 80 paise CRS and intangible assets at 3 rupees and 20 paise CRS, do remember the company is reporting its net block, which is net of accumulated depreciation. Have a look at the note 10, which is associated with fixed assets. At the top of the note you can see the gross block, depreciation, amortization, and net block being highlighted. I have also highlighted 2 net block numbers which tallies with what was mentioned in the balance sheet. Let us look at a few more interesting aspects on this note. Notice under tangible assets you can see the list of all the assets the company owns. For example, the company has listed buildings as one of its tangible asset. I have highlighted this part. As of the 31st of March 2013, FY13, AARBL reported the value of the building at 93 rupees and 40 paise CRS. During the FY14, the company added 85 rupees and 80 paise CRS worth of building. This amount is classified as additions during the year. Further, they also wound up 0.668 CRS worth of building. This amount is classified as deductions during the year. Hence, the current year value of the building would be previous year's value of building plus addition during this year, deduction during the year. 93.4 plus 85.8 to 0.668 equals 178.5 CRS. You can notice this number being highlighted in blue in the above image. Do remember this is the gross block of the building. From the gross block one needs to deduct the accumulated depreciation to arrive at the net block. In the snapshot below, I have highlighted the depreciation section belonging to the building. As of the 31st of March 2013, FY13, ARBL has depreciated 17 rupees and 20 paise CRS, to which they need to add 2 rupees and 80 paise CRS belonging to the year FY14. Adjust 0.376 CRS as the deduction for the year. Thus, the total depreciation for the year is previous year's depreciation value plus current year's depreciation, deduction for the year, equals 17.2 plus 2.8 to 0.376. Total depreciation equals 19 rupees 0.736 CRS. This is highlighted in red in the image above. So, we have building gross block at 178 rupees and 60 paise CRS and depreciation at 19 rupees and 73 paise CRS, which gives us a net block of 158 rupees and 80 paise CRS, 178.6 to 19.73. The same has been highlighted in the image below. The same exercise is carried out for all the other tangible and intangible assets to arrive at the total net block number. The next 2 line items under the fixed assets are capital work in progress (CWIP) and intangible assets under development. CWIP includes building under construction, machinery under assembly, etc. at the time of preparing the balance sheet. Hence it is aptly called the capital work in progress. This amount is usually mentioned in the net block section. CWIP is the work that is not yet complete but where a capital expenditure has already been incurred. As we can see, ARBL has 144 rupees and 30 paise CRS under CWIP. Once the construction process is done and the asset is put to use, the asset is moved to tangible assets under fixed assets from CWIP. The last line item is intangible assets under development. This is similar to CWIP but for intangible assets. The work in process could be patent filing, copyright filing, brand development, etc. This is at a minuscule cost of 0.3 CRS for ARBL. All these costs are added to arrive at the total fixed cost of the company. 7.3 Non-current assets, other line items. Besides the fixed assets under the non-current assets, there are other line items as well. Here is a snapshot for the same. Non-current investments are investments made by ARBL with a long-term perspective. This stands at 16 rupees and 7 paise CRS. The investment could be anything: buying listed equity shares, minority stake in other companies, debentures, mutual funds, etc. Here is the partial, as I could not fit the entire image, snapshot of note 11. This should give you a perspective. The next line item is long-term loans and advances, which stand at 56 rupees and 70 paise CRS. These are loans and advances given out by the company to other group companies, employees, suppliers, vendors, etc. The last line item under the non-current assets is other non-current assets, which is at Rs. 0.122 CRS. This includes other miscellaneous long-term assets. 7.4 Current assets. Current assets are assets that can be easily converted to cash, and the company foresees a situation of consuming these assets within 365 days. Current assets are the assets that a company uses to fund its day-to-day operations and ongoing expenses. The most common current assets are cash and cash equivalents, inventories, receivables, short-term loans and advances, and sundry debtors. Here is the snapshot of the current assets of ARBL. The first line item on the current assets is inventory, which stands at 335 rupees CRS. Inventory includes all the finished goods manufactured by the company, raw materials in stock, goods that are manufactured incompletely, etc. Inventories are goods at various stages of production and hence have not been sold. When any product is manufactured in a company, it goes through various processes from raw material to work in progress to a finished good. Snapshot of note 14 associated with inventory of the company is as shown below. As you can see, a bulk of the inventory value comes from raw material and work in progress. The next line item is trade receivables, also referred to as accounts receivables. This represents the amount of money that the company is expected to receive from its distributors, customers, and other related parties. The trade receivable for ARBL stands at 452 rupees and 70 paise CRS. The next line item is the cash and cash equivalents, which are considered the most liquid assets found in the balance sheet of any company. Cash comprises of cash on hand and cash on demand. Cash equivalents are short-term, highly liquid investments which has a maturity date of less than 3 months from its acquisition date. This stands at 294 rupees and 50 paise CRS. Note 16 associated with cash and bank balances is as shown below. As you can see, the company has cash parked in various types of accounts. The next line item is short-term loans and advances that the company has tendered and which is expected to be repaid back to the company within 365 days. It includes various items such as advances to suppliers, loans to customers, loans to employees, advance tax payments, income tax, wealth tax, etc. This stands at 211 rupees and 90 paise CRS. Following this is the last line item on the asset side and in fact on the balance sheet itself. This is the other current assets, which are not considered important, hence termed other. This stands at 4 rupees and 30 paise CRS. To sum up, the total assets of the company would now be fixed assets plus current assets equals 840 rupees .831 CRS plus 1,298 rupees and 61 paise CRS equals Rs. 2,139.441 CRS, which is exactly equal to the liabilities of the company. With this, we have now run through the entire asset side of the balance sheet, and in fact the whole of balance sheet itself. Let us relook at the balance sheet in its entirety. As you can see in the above, the balance sheet equation holds true for ARBL's balance sheet. Asset equals shareholders' funds plus liabilities. Do remember, Over the last few chapters we have only inspected the balance sheet and the P&L statements. However, we have not analyzed the data to infer if the numbers are good or bad. We will do the same when we look into the financial ratio analysis chapter. In the next chapter, we will look into the last financial statement, which is the cash flow statement. However, before we conclude this chapter, we must look into the many ways the balance sheet and the P&L statement are interconnected. 7.5 Connecting the P&L and balance sheet. Let us now focus on the balance sheet and the P&L statement and the multiple ways they are connected or affect to each other. Have a look at the following image. In the image above, on the left-hand side we have the line items on a typical standard P&L statement. Corresponding to that on the right-hand side we have some of the standard balance sheet items. From the previous chapters, you already know what each of these line items mean. However, we will now understand how the line items in the P&L and the balance sheet are connected to each other. To begin with, consider the revenue from sales. When a company makes a sale, it incurs expenses. For example, if the company undertakes an advertisement campaign to spread awareness about its products, then naturally the company has to spend cash on the campaign. The money spent tends to decrease the cash balance. Also, if the company makes a sale on credit, the accounts receivables go higher. Operating expenses includes purchase of raw material, finished goods and other similar expenses. When a company incurs these expenses to manufacture goods, two things happen. 1. If the purchase is on credit, which invariably is, then the trade payables, accounts payable go higher. 2. The inventory level also gets affected. Whether the inventory value is high or low depends on how much time the company needs to sell its products. When companies purchase tangible assets or invest in brand-building exercises, intangible assets, the company spreads the purchase value of the asset over the economic useful life of the asset. This tends to increase the depreciation mentioned in the balance sheet. Do remember the balance sheet is prepared on a flow basis. Hence the depreciation in balance sheet is accumulated year on year. Please note, depreciation in balance sheet is referred to as the accumulated depreciation. Other income includes monies received in the form of interest income, sale of subsidiary companies, rental income, etc. Hence, when companies undertake investment activities, the other incomes tend to get affected. As and when the company undertakes debt, it could be short-term or long-term. The company obviously spends money towards financing the debt. The money that goes towards financing the debt is called the finance cost, borrowing cost. Hence, when debt increases, the finance cost also increases and vice versa. Finally, as you may recall, the profit after tax (PAT) adds to the surplus of the company, which is a part of the shareholders' equity. Key takeaways from this chapter. The asset side of the balance sheet displays all the assets the company owns. Assets are expected to give an economic benefit during its useful life. Assets are classified as non-current and current asset. The useful life of non-current assets is expected to last beyond 365 days or 12 months. Current assets are expected to pay off within 365 days or 12 months. Assets inclusive of depreciation are called the gross block. Net block equals gross block, accumulated depreciation. The sum of all assets should equal the sum of all liabilities. Only then the balance sheet is said to have balanced. The balance sheet and P&L statement are inseparable. They are connected to each other in many ways. 32 Responses to understanding the Open a ZERODHA account. Chapter 8. The Cash Flow Statement. 8.1 Overview. The cash flow statement is a very important financial statement, as it reveals how much cash the company is actually generating. Is this information not revealed in the P&L statement, you may think? Well, the answer is both a yes and a no. Consider the following scenario. Assume a simple coffee shop selling coffee and short eats. All the sales the shop does is mostly on cash basis. Meaning if a customer wants to have a cup of coffee and a snack, he needs to have enough money to buy what he wants. Going by that on a particular day. Assume the shop manages to sell 2,500 rupees per worth of coffee and 3,000 rupees per worth. Open a ZERODHA account. Chapter 8. The Cash Flow Statement. 8.1 Overview. The cash flow statement is a very important financial statement, as it reveals how much cash the company is actually generating. Is this information not revealed in the P&L statement, you may think? Well, the answer is both a yes and a no. Consider the following scenario. Assume a simple coffee shop selling coffee and short eats. All the sales the shop does is mostly on cash basis. Meaning if a customer wants to have a cup of coffee and a snack, he needs to have enough money to buy what he wants. Going by that on a particular day. Assume the shop manages to sell 2,500 rupees per worth of coffee and 3,000 rupees per worth of snacks. It is evident that the shop's income is 5,500 rupees per for that day. 5,500 rupees per is reported as revenues in P&L. And there is no ambiguity with this. Now think about another business that sells laptops. For sake of simplicity, let us assume that the shop sells only one type of laptop at a standard fixed rate of 25,000 rupees per laptop. Assume on a certain day, the shop manages to sell 20 such laptops. Clearly, the revenue for the shop would be 25,000 rupees x 20 equals 500,000 rupees per. But what if 5 of the 20 laptops were sold on credit? A credit sale is when the customer takes the product today but pays the cash at a later point in time. In this situation, here is how the numbers would look. Cash sale. 15 * 25,000 equals 375,000 rupees per. Credit sale. 5 * 25,000 equals 125,000 rupees per. Total sales. 500,000 rupees per. If this shop was to show its total revenue in its P&L statement, you would just see a revenue of 500,000 rupees per, which may seem good on the face of it. However, how much of this 500,000 rupees per is actually present in the company's bank account is not clear. What if this company had a loan of 400,000 rupees per that had to be repaid back urgently? Even though the company has a sale of 500,000 rupees, it has only 375,000 rupees per in its account. This means the company has a cash crunch, as it cannot meet its debt obligations. The cash flow statement captures this information. A statement of cash flows should be presented as an integral part of an entity's financial statements. Hence, in this context, evaluation of the cash flow statement is highly critical, as it reveals, amongst other things, the true cash position of the company. To sum up, every company's financial performance is not so much dependent on the profits earned during a period, but more realistically on liquidity or cash flows. 8.2 Activities of a company. Before we go ahead to understand the cash flow statement, it is important to understand the activities of a company. If you think about a company and the various business activities it undertakes, you will realize that the company's activities can be classified under one of the 3 standard baskets. We will understand this in terms of an example. Imagine a business, maybe a very well-established fitness center, Tal Walkers, Gold's Gym, etc., with a sound corporate structure. What are the typical business activities you think a fitness center would have? Let me go ahead and list a few business activities. Display advertisements to attract new customers. Hire fitness instructors to help clients in their fitness workout. Buy new fitness equipments to replace worn-out equipments. Seek short-term loan from bankers. Issue a certificate of deposit for raising funds. Issue new shares to a few known friends to raise fresh capital for expansion, also called preferential allotment. Invest in a startup company working towards innovative fitness regimes. Park excess money, if any, in fixed deposits. Invest in a building coming up in the neighborhood for opening a new fitness center sometime in the future. Upgrade the sound system for a better workout experience. As you can see, the above listed business activities are quite diverse, however, they are all related to the business. We can classify these activities as operational activities, OA. Activities that are directly related to the daily core business operations are called operational activities. Typical operating activities include sales, marketing, manufacturing, technology upgrade, resource hiring, etc. Investing activities, IA. Activities pertaining to investments that the company makes with an intention of reaping benefits at a later stage. Examples include parking money in interest-bearing instruments, investing in equity shares, investing in land, property, plant and equipment, intangibles and other non-current assets, etc. Financing activities, FA. Activities pertaining to all financial transactions of the company, such as distributing dividends, paying interest to service debt, raising fresh debt, issuing corporate bonds, etc. All activities a legitimate company performs can be classified under one of the above three mentioned categories. Keeping the above three activities in perspective, we will now classify each of the above mentioned activities into one of the three categories baskets. Display advertisements to attract new customers, OA. Hire fitness instructors to help customers with their fitness workout, OA. Buy new fitness equipment to replace worn-out equipment, OA. Seek a short-term loan from bankers, FA. Issue a certificate of deposit, CD, for raising funds, FA. Issue new shares to few known friends to raise fresh capital for expansion, also called preferential allotment, FA. Invest in a startup company working towards innovative fitness regimes, IA. Park excess money, if any, in fixed deposit, IA. Invest in a building coming up in the neighborhood for opening a new fitness center sometime in the future, IA. Upgrade the sound system for better workout experience, OA. Now think about the cash moving in and out of the company and its impact on the cash balance. Each activity that the company undertakes has an impact on cash. For example, upgrade the sound system for a better workout experience means the company has to pay money towards the purchase of a new sound system. Hence the cash balance decreases. Also, it is interesting to note that the new sound system itself will be treated as a company asset. Keeping this in perspective, we will now understand for the example given above how the various activities listed would impact the cash balance and how would it impact the balance sheet. Activity No activity type rational cash balance on balance sheet. 01. OA expenditure towards advertisement decreases, treated as an asset as it increases the brand value. 02. OA expenditure towards new recruits decreases, treated as an asset as it increases the company's intellectual capital. 03. OA expenditure towards new equipment decreases, treated as asset. 04. FA loan means cash inflow to business increases, loan is a liability. 05. FA deposits via CD means cash inflow increases, CD is a liability. 06. FA issue of fresh capital means cash inflow increases, treated as a liability as share capital increases. 07. IA investment in startup means cash outflow decreases, investment is an ASO. 08. IA money parked in FD means cash going out of business decreases, equivalent to cash, hence considered an asset. 09. IA investment in building means cash going out of business decreases, gross block considered an ASO. 10. OA expenditure towards the sound system decreases, treated as an asset. The table above is color-coded. Increase in cash is color-coded in blue. Decrease in cash is color-coded in red. Assets are color-coded in green and liabilities are color-coded in purple. If you look through the table and start correlating the cash balance and asset liability, you will observe that whenever the liabilities of the company increases, the cash balance also increases. This means if the liabilities decreases, the cash balance also decreases. Whenever the asset of the company increases, the cash balance decreases. This means if the assets decreases, the cash balance increases. The above conclusion is the key concept while constructing a cash flow statement. Also, extending this further, you will realize that each activity of the company, be it operating activity, financing activity, or investing activity, either produces cash net increase in cash or reduces net decrease in cash, the cash for the company. Hence, the total cash flow for the company will be cash flow of the company equals net cash flow from operating activities plus net cash flow from investing activities plus net cash flow from financing activities. 8.3 The cash flow statement. Having some insight into the cash flow statement, you would now appreciate the fact that you need to look into the cash flow statement to review the company from a cash perspective. Typically, when companies present their cash flow statement, they split the statement into 3 segments to explicitly show how much cash the company has generated across the 3 business activities. Continuing with our example from the earlier chapters. Here is the cash flow statement of Amara Raja Batteries Limited, AARBL. I will skip going through each line item as most of them are self-explanatory. However, I want you to notice that ARBL has generated 278 rupees and 70 paise CRS from operating activities. Note: a company which has a positive cash flow from operating activities is always a sign of financial well-being. Here is the snapshot of ARBL's cash flow from investing activities. As you can see, ARBL has consumed 344 rupees and 80 paise CRS in its investing activities. This is quite intuitive, as investing activities tend to consume cash. Also remember, healthy investing activities foretells the investor that the company is serious about its business expansion. Of course, how much is considered healthy and how much is not is something we will understand as we proceed through this module. Finally, here is the snapshot of ARBL's cash balance from financing activities. ARBL consumed 53 rupees and 10 paise CRS through its financing activities. If you notice, the bulk of the money went in paying dividends. Also, if ARBL takes on new debt in future, it would lead to an increase in the cash balance. Remember, increase in liabilities increases cash balance. We know from the balance sheet that ARBL did not undertake any new debt. Let us summarize the cash flow from all the activities. Cash flow from rupees crores 2013-14, rupees crores 2012-13. Operating activities 278.7, 335.4. Investing activities 344.8, 120.05. Financing activities 53.1, 34.96. Total 119.19, 179.986. This means the company consumed a total cash of 119 rupees and 19 paise CRS for the financial year 2013-2014. Fair enough. But what about the cash from the previous year? As we can see, the company generated 179 rupees 0.986 CRS through all its activities from the previous year. Here is an extract from ARBL's cash flow statement. Look at the section highlighted in green for the year 2013-14. It says the opening balance for the year is 409 rupees and 46 paise CRS. How did they get this? Well, this happens to be the closing balance for the previous year. Refer to the arrow marks. Add to this the current year's cash equivalents, which is 119 rupees and 19 paise CRS, along with a minor forex exchange difference of 2 rupees and 58 paise CRS. We get the total cash position of the company, which is 292 rupees and 86 paise CRS. This means, while the company guzzled cash on a yearly basis, they still have adequate cash, thanks to the carry forward from the previous year. Note: the closing balance of 2013-14 will now be the opening balance for the FY 2014-15. You can watch out for this when ARBL provides its cash flow numbers for the year ended the 31st of March 2015. At this point, let us run through a few interesting questions and answers. What does 292 rupees and 86 paise CRS actually state? This literally shows how much cash ARBL has in its various bank accounts. What is cash? Cash comprises cash on hand and demand deposits. Obviously, this is a liquid asset of the company. What are liquid assets? Liquid assets are assets that can be easily converted to cash or cash equivalents. Are liquid assets similar to current items that we looked at in the balance sheet? Yes. You can think of it that way. If cash is current and cash is an asset, shouldn't it reflect under the current asset on the balance sheet? Exactly, and here it is. Look at the balance sheet extract below. Clearly, we can now infer that the cash flow statement and the balance sheet interact with each other. This is in line with what we had discussed earlier, i.e. all the three financial statements are interconnected with each other. 8.4a Brief on the financial statements. Over the last few chapters we have discussed the three important financial statements of the company, i.e. the P&L statement, the balance sheet, and the cash flow statement of the company. While the cash flow and P&L statement are prepared on a standalone basis representing the financial position for the given year, the balance sheet is prepared on a flow basis. The P&L statement discusses how much the company earned as revenues versus how much the company expended in terms of expenses. The retained earnings of the company, also called the surplus of the company, are carried forward to the balance sheet. The P&L also incorporates the depreciation number. The depreciation mentioned in the P&L statement is carried forward to the balance sheet. The balance sheet details the company's assets and liabilities. On the liabilities side of the balance sheet, the company represents the shareholders' funds. The assets should always be equal to the liabilities. Only then do we say the balance sheet has balanced. One of the key details on the balance sheet is the cash and cash equivalents of the firm. This number tells us how much money the company has in its bank account. This number comes from the cash flow statement. The cash flow statement provides information to the users of the financial statements about the entity's ability to generate cash and cash equivalents, as well as indicates the cash needs of a company. The statement of cash flows are prepared on a historical basis, providing information about the cash and cash equivalents, classifying cash flows into operating, financing, and investing activities. The final number of the cash flow tells us how much money the company has in its bank account. We have so far looked into how to read the financial statements and what to expect out of each one of them. We have not yet ventured into how to analyze these numbers. One of the ways to analyze the financial numbers is by calculating a few important financial ratios. In fact, we will focus on the financial ratios in the next few chapters. Key takeaways from this chapter. The cash flow statement gives us a picture of the true cash position of the company. A legitimate company has three main activities: operating activities, investing activities, and the financing activities. Each activity either generates or drains money for the company. The net cash flow for the company is the sum of operating activities, investing activities, and the financing activities. Investors should specifically look at the cash flow from operating activities of the company. When the liabilities increase, cash level increases, and vice versa. When the assets increase, cash level decreases, and vice versa. The net cash flow number for the year is also reflected in the balance sheet. The statement of cash flow is a useful addition to the financial statements of a company because it indicates the company's performance. 48 responses to Open a ZERODHA account. Chapter 9. The Financial Ratio Analysis, Part 1. 9.1a Note on financial ratios. Over the last few chapters we have understood how to read the financial statements. We will now focus our attention on analyzing these financial statements. The best way to analyze the financial statements is by studying the financial ratios. The theory of financial ratios was made popular by Benjamin Graham, who is popularly known as the father of fundamental analysis. Financial ratios help in interpreting the results and allows comparison with previous years and other companies in the same industry. A typical financial ratio utilizes data from the financial statement to compute its value. Before we start understanding the financial ratios, we need to be aware of certain attributes of the financial ratios. On its own merit, the financial ratio of a company conveys very little information. For instance, assume Ultratech Cements Limited has a profit margin of 15%. How useful do you think this information is? Well, not much really. 15% profit margin is good. But how would I know if it is the best? However, assume you figure out ACC Cement's profit margin is 12%. Now, as we comparing two similar companies, comparing the profitability makes sense. Clearly, Ultratech Cements Limited seems to be a more profitable company between the two. The point that I am trying to drive across is that more often than not, financial ratios on its own is quite mute. The ratio makes sense only when you compare the ratio with another company of a similar size or when you look into the trend of the financial ratio. This means that once the ratio is computed, the ratio has to be analyzed either by comparison or tracking the ratio's historical trend to get the best possible inference. Also, here is something that you need to be aware of while computing ratios. Accounting policies may vary across companies and across different financial years. A fundamental analyst should be cognizant of this fact and should adjust the data accordingly before computing the financial ratio. 9.2 The financial ratios. Financial ratios can be somewhat loosely classified into different categories, namely, profitability ratios, leverage ratios, valuation ratios, operating ratios. The profitability ratios help the analyst measure the profitability of the company. The ratios convey how well the company is able to perform in terms of generating profits. Profitability of a company also signals the competitiveness of the management, as the profits are needed for business expansion and to pay dividends to its shareholders. A company's profitability is an important consideration for the shareholders. The leverage ratios, also referred to as solvency ratios, gearing ratios, measures the company's ability in the long term to sustain its day-to-day operations. Leverage ratios measure the extent to which the company uses the debt to finance growth. Remember, for the company to sustain its operations, it has to pay its bills and obligations. Solvency ratios help us understand the company's long-term sustainability, keeping its obligation in perspective. The valuation ratios compare the stock price of the company with either the profitability of the company or the overall value of company to get a sense of how cheap or expensive the stock is trading. Thus, this ratio helps us in analyzing whether the current share price of the company is perceived as high or low. In simpler words, the valuation ratio compares the cost of a security with the perks of owning the stock. The operating ratios, also called the activity ratios, measures the efficiency at which a business can convert its assets, both current and non-current, into revenues. This ratio helps us understand how efficient the management of the company is. For this reason, operating ratios are sometimes called the management ratios. Strictly speaking, ratios, irrespective of the category it belongs to, convey a certain message, usually related to the financial position of the company. For example, profitability ratio can convey the efficiency of the company, which is usually measured by computing the operating ratio. Because of such overlaps, it is difficult to classify these ratios. Hence, the ratios are somewhat loosely classified. 9.3 The profitability ratios. We will look into the following ratios under the profitability ratio: EBITDA margin, operating profit margin, EBITDA growth, CAGR, PAT margin, PAT growth, CAGR, return on equity, ROE, return on asset, ROA, return on capital employed, ROCE. EBITDA margin. The earnings before interest, tax, depreciation and amortization EBITDA margin indicates the efficiency of the management. It tells us how efficient the company's operating model is. EBITDA margin tells us how profitable, in percentage terms, the company is at an operating level. It always makes sense to compare the EBITDA margin of the company versus its competitor to get a sense of the management's efficiency in terms of managing their expense. In order to calculate the EBITDA margin, we first need to calculate the EBITDA itself. EBIT equals operating revenues, operating expense. Operating revenues equals total revenue, other income. Operating expense equals total expense, finance cost, depreciation and amortization. EBITDA margin equals EBITDA, total revenue, other income. Continuing the example of Amara Raja Batteries Limited. The EBITDA margin calculation for the FY14 is as follows. We first calculate EBITDA, which is computed as follows. Total revenue, other income, total expense, finance cost, depreciation and amortization. Note: other income is income by virtue of investments and other non-operational activity. Including other income in EBITDA calculation would clearly skew the data. For this reason, we have to exclude other income from total revenues. 3,482.46, 2,942 0.7 to 65 equals 3,436, 2,876 equals 560 crores. Hence the EBITDA margin is 563,436 equals 16.3%. I have two questions for you at this stage. What does an EBITDA of 560 rupees CRS and an EBITDA margin of 16.3% indicate? How good or bad an EBITDA margin of 16.3% is? The first question is fairly simple. An EBITDA of 560 rupees CRS means that the company has retained 560 rupees CRS from its operating revenue of 3,436 rupees CRS. This also means out of 3,436 rupees CRS, the company spent 2,876 rupees CRS towards its expenses. In percentage terms, the company spent 83.7% of its revenue towards its expenses and retained 16.3% of the revenue at the operating level for its operations. Now for the second question. Hopefully you should not have an answer. Remember, we did discuss this point earlier in this chapter. A financial ratio on its own conveys very little information. To make sense of it, we should either see the trend or compare it with its peers. Going with this, a 16.3% EBITDA margin conveys very little information. To make some sense of the EBITDA margin, let us look at Amara Raja's EBITDA margin trend for the last 4 years. All numbers in ours CRS. Except EBITDA margin. Year operating revenues, operating expense, EBITDA margin. 2011, 1761, 1504, 257, 14.6%. 2012, 2364, 2025, 340, 14.4%. 2013, 2959, 2508, 451, 15.2%. 2014, 3437, 2876, 560, 16.3%. It appears that ARBL has maintained its EBITDA at an average of 15%. And in fact, on a closer look, it is clear the EBITDA margin is increasing. This is a good sign as it shows consistency and efficiency in the management's operational capabilities. In 2011, the EBITDA was 257 rupees CRS, and in 2014, the EBITDA is 560 rupees CRS. This translates to a 4-year EBITDA CAGR growth of 21%. Please note, we have discussed the formula for CAGR in Module 1. Clearly, it appears that both EBITDA margin and EBITDA growth are quite impressive. However, we still do not know if it is the best. In order to find out if it is the best, one needs to compare these numbers with its competitors. In case of ARBL, it would be Exide Batteries Limited. I would encourage you to do the same for Exide and compare the results. PAT margin. While the EBITDA margin is calculated at the operating level, the profit after tax PAT margin is calculated at the final profitability level. At the operating level, we consider only the operating expenses. However, there are other expenses such as depreciation and finance costs, which are not considered. Along with these expenses, there are tax expenses as well. When we calculate the PAT margin, all expenses are deducted from the total revenues of the company to identify the overall profitability of the company. PAT margin equals PAT total revenues. PAT is explicitly stated in the annual report. ARBL's PAT for the FY14 is 367 rupees CRS on the overall revenue of 3,482 rupees CRS, including other income. This translates to a PAT margin of equals 367 3,480 seconds equals 10.5%. Here is the PAT and PAT margin trend for ARBL. Year PAT in INR CRS PAT margin 2011-1488.4%, 2012-2158.9%, 2013-2879.6%, 2014-367 10.5%. The PAT and PAT margin trend seems impressive as we can clearly see a margin expansion. The 4-year CAGR growth stands at 25.48%, which is again good. Needless to say, it always makes sense to compare ratios with its competitors. Return on equity, ROE. The return on equity, ROE, is a very important ratio, as it helps the investor assess the return the shareholder earns for every unit of capital invested. ROE measures the entity's ability to generate profits from the shareholders' investments. In other words, ROE shows the efficiency of the company in terms of generating profits to its shareholders. Obviously, higher the ROE, the better it is for the shareholders. In fact, this is one of the key ratios that helps the investor identify investable attributes of the company. To give you a perspective, the average ROE of top Indian companies vary between 14 to 16%. I personally prefer to invest in companies that have a ROE of 18% upwards. This ratio is compared with the other companies in the same industry and is also observed over time. Also note, if the ROE is high, it means a good amount of cash is being generated by the company. Hence the need for external funds is less. Thus a higher ROE indicates a higher level of management performance. ROE can be calculated as net profit, shareholders' equity asterisk 100. There is no doubt that ROE is an important ratio to calculate. But like any other financial ratios, it also has a few drawbacks. To help you understand its drawbacks, consider this hypothetical example. Assume Vishal runs a pizza store. To bake pizzas, Vishal needs an oven which costs him 10,000 rupees per. Oven is an asset to Vishal's business. He procures the oven from his own funds and seeks no external debt. At this stage you would agree on his balance sheet he has a shareholder equity of 10,000 rupees and an asset equivalent to 10,000 rupees. Now, assume in his first year of operation, Vishal generates a profit of 2,500 rupees per. What is his ROE? This is quite simple to compute. ROE equals 2,500 10,000 asterisk 100 equals 25.0%. Now let us twist the story a bit. Vishal has only 8,000 rupees per. He borrows 2,000 rupees from his father to purchase an oven worth 10,000 rupees per. How do you think his balance sheet would look? On the liability side he would have shareholder equity equals 8,000 rupees. Debt equals 2,000 rupees. This makes Vishal's total liability Rs. 10,000. Balancing this on the asset side, he has an asset worth 10,000 rupees. Let us see how his ROE looks now. ROE equals 2,500 8,000 asterisk 100 equals 31.25%. With an additional debt, the ROE shot up quite significantly. Now, what if Vishal had only 5,000 rupees and borrowed the additional 5,000 rupees from his father to buy the oven? His balance sheet would look like this. On the liability side he would have Shareholder equity equals 5,000 rupees. Debt equals 5,000 rupees. Vishal's total liability is Rs. 10,000. Balancing this on the asset side, he has an asset worth 10,000 rupees. Let us see how his ROE looks now. ROE equals 2,500 5,000 asterisk 100 equals 50.0%. Clearly, higher the debt Vishal seeks to finance his asset, which in turn is required to generate profits, higher is the ROE. A high ROE is great, but certainly not at the cost of high debt. The problem is with a high amount of debt, running the business gets very risky as the finance cost increases drastically. For this reason, inspecting the ROE closely becomes extremely important. One way to do this is by implementing a technique called the DuPont model, also called DuPont identity. This model was developed in 1920s by the DuPont Corporation. DuPont model breaks up the ROE formula into 3 components, with each part representing a certain aspect of business. The DuPont analysis uses both the P&L statement and the balance sheet for the computation. The ROE as per DuPont model can be calculated as, if you notice the above formula, the denominator and the numerator cancels out with one another, eventually leaving us with the original ROE formula, which is ROE equals net profit, shareholder equity asterisk 100. However, in the process of decomposing the ROE formula, we gained insights into 3 distinct aspects of the business. Let us look into the 3 components of the DuPont model that makes up the ROE formula. Net profit margin equals net profits, net sales asterisk 100. This is the first part of the DuPont model, and it expresses the company's ability to generate profits. This is nothing but the PAT margin we looked at earlier in this chapter. A low net profit margin would indicate higher costs and increased competition. Asset turnover equals net sales, average total asset. Asset turnover ratio is an efficiency ratio that indicates how efficiently the company is using its assets to generate revenue. Higher the ratio, it means the company is using its assets more efficiently. Lower the ratio, it could indicate management or production problems. The resulting figure is expressed as number of times per year. Financial leverage equals average total assets, shareholders' equity. Financial leverage helps us answer this question. For every unit of shareholders' equity, how many units of assets does the company have? For example, if the financial leverage is 4, this means for every 1 rupee of equity, the company supports 4 rupees worth of assets. Higher the financial leverage along with increased amounts of debt will indicate the company is highly leveraged, and hence the investor should exercise caution. The resulting figure is expressed as number of times per year. As you can see, the DuPont model breaks up the ROE formula into 3 distinct components, with each component giving an insight into the company's operating and financial capabilities. Let us now proceed to implement the DuPont model to calculate Amara Raj's ROE for the FY14. For this we need to calculate the values of the individual components. Net profit margin. As I mentioned earlier, this is same as the PAT margin. From our calculation earlier, we know the net profit margin for ARBL is 9.2%. Asset turnover equals net sales, average total assets. We know from the FY14 annual report, net sales of ARBL stands at 3,437 rupees CRS. The denominator has average total assets, which we know can be sourced from the balance sheet. But what does the word average indicate? From ARBL's balance sheet, the total asset for FY14 is 2,139 rupees CRS. But think about this. The reported number is for the financial year 2014, which starts from 1st of April 2013 and close on the 31st of March 2014. This implies that at the start of the financial year 2014, the 1st of April 2013, the company must have commenced its operation with assets that it carried forward from the previous financial year, FY 2013. During the financial year, FY 2014, the company has acquired some more assets which when added to The previous year's FY 2013 assets totaled to 2,139 rupees CRS. Clearly the company started the financial year with a certain rupee value of assets but closed the year with a totally different rupee value of assets. Keeping this in perspective, if I were to calculate the asset turnover ratio, which asset value should I consider for the denominator? Should I consider the asset value at the beginning of the year or at the asset value at the end of the year? To avoid confusion, the practice is to take average of the asset values for the 2 financial years. Do remember this technique of averaging line items, as we will be using this across other ratios as well. From ARBL's annual report we know net sales in FY14 is 3,437 rupees CRS. Total assets in FY13 is 1,770 rupees CRS. Total assets in FY14 is 2,139 rupees CRS. Average assets equals 1770 plus 2,139, 2 equals 1955. Asset turnover equals 3,437 1,955 equals 1.75 times. This means for every 1 rupee of asset deployed, the company is generating 1 rupee and 75 paise in revenues. We will now calculate the last component, that is the financial leverage. Financial leverage equals average total assets, average shareholders' equity. We know the average total assets is 1,955 rupees. We just need to look into the shareholders' equity. For reasons similar to taking the average assets as opposed to just the current year assets, we will consider average shareholder equity as opposed to just the current year's shareholder equity. Shareholders' equity for FY13 equals 1,059 rupees CRS. Shareholders' equity for FY14 equals 1,362 rupees CRS. Average shareholder equity equals 1,211 rupees CRS. Financial leverage equals 1,955 1,211 equals 1.61 times. Considering ARBL has little debt, financial leverage of 1.61 is indeed an encouraging number. The number above indicates that for every 1 rupee of equity, ARBL supports 1 rupee and 61 paise of assets. We now have all the inputs to calculate ROE for ARBL. We will now proceed to do the same. ROE equals net profit margin x asset turnover x financial leverage equals 9.2% asterisk 1.75 asterisk 1.61. Approximately 25.9%. Quite impressive, I must say. I understand this is a lengthy way to calculate ROE, but this is perhaps the best way, as in the process of calculating ROE, we can develop valuable insights into the business. DuPont model not only answers what the return is but also the quality of the return. However, if you wish to do a quick ROE calculation, you can do so the following way. ROE equals net profits, AVG shareholders' equity. From the annual report we know for the FY14 the PAT is 367 rupees CRS. ROE equals 367 1,211 equals 30.31%. Return on asset ROA. Having understood the DuPont model, understanding the next 2 ratios should be simple. Return on assets ROA evaluates the effectiveness of the entity's ability to use the assets to create profits. A well-managed entity limits investments in non-productive assets. Hence, ROA indicates the management's efficiency at deploying its assets. Needless to say, higher the ROA, the better it is. ROA equals net income plus interest asterisk 1 tax rate total average assets. From the annual report, we know net income for FY14 equals 367 rupees and 40 paise CRS. And we know from the DuPont model the total average assets for FY13 and FY14 equals 1,955 rupees CRS. So what does interest asterisk 1 tax rate mean? Well, think about it. The loan taken by the company is also used to finance the assets, which in turn is used to generate profits. So in a sense, the debt holders, entities who have given loan to the company, are also a part of the company. From this perspective, the interest paid out also belongs to a stakeholder of the company. Also, the company benefits in terms of paying lesser taxes when interest is paid out. This is called a tax shield. For these reasons, we need to add interest by accounting for the tax shield while calculating the ROA. The interest amount, finance cost, is 7 rupees CRS. Accounting for the tax shield, it would be equals 7 asterisk 1 to 32% equals 4.76 CRS. Please note, 32% is the average tax rate. Hence ROA would be ROA equals 367.4 plus 4.76, 1955. Approximately 372.16, 1955. Approximately 19.03%. Return on capital employed, ROCE. The return on capital employed indicates the profitability of the company taking into consideration the overall capital it employs. Overall capital includes both equity and debt, both long-term and short-term. ROCE equals profit before interest and taxes, overall capital employed. Overall capital employed equals short-term debt plus long-term debt plus equity. From ARBL's annual report we know profit before interest and taxes equals 537 rupees and 70 paise CRS. Overall capital employed. Short-term debt 8 rupees and 30 paise CRS. Long-term borrowing 75 rupees and 90 paise CRS. Shareholders' equity equals 1,362 rupees CRS. Overall capital employed 8.3 plus 75.9 plus 1362 equals 1,446.2 CRS. ROCE equals 537.7, 1,446.2 equals 37.18%. Key takeaways from this chapter. A financial ratio is a useful financial metric of a company. On its own merit, the ratio conveys very little information. It is best to study the ratio's recent trend or compare it with the company's peers to develop an opinion. Financial ratios can be categorized into profitability, leverage, valuation, and operating ratios. Each of these categories give the analyst a certain view on the company's business. EBITDA is the amount of money the company makes after subtracting the operational expenses of the company from its operating revenue. EBITDA margin indicates the percentage profitability of the company at the operating level. PAT margin gives the overall profitability of the firm. Return on equity, ROE, is a very valuable ratio. It indicates how much return the shareholders are making over their initial investment in the company. A high ROE and a high debt is not a great sign. DuPont model helps in decomposing the ROE into different parts, with each part throwing light on different aspects of the business. DuPont method is probably the best way to calculate the ROE of a firm. Return on assets is an indicator of how efficiently the company is utilizing its assets. Return on capital employed indicates the overall return the company generates considering both the equity and debt. For the ratios to be useful, it should be analyzed in comparison with other companies in the same industry. Also, ratios should be analyzed both at a single point in time and as an indicator of broader trends over time. 107 responses to Open a ZERODHA account. Chapter 10. The Financial Ratio Analysis, Part 2. 10.1 The Leverage Ratios. We touched upon the topic of financial leverage while discussing return on equity and the DuPont analysis. The use of leverage debt is like a double-edged sword. Well-managed companies seek debt if they foresee a situation where they can deploy the debt funds in an environment which generates a higher return in contrast to the interest payments the company has to make to service its debt. Do recollect a judicious use of debt to finance assets also increases the return on equity. However, if a company takes on too much debt, then the interest paid to service the debt eats into the profit share of the shareholders. Hence, there is a very thin line that separates the good and the bad debt. Leverage ratios mainly deal with the overall extent of the company's debt and help us understand the company's financial leverage better. We will be looking into the following leverage ratios: interest coverage ratio, debt to equity ratio, debt to asset ratio, financial leverage ratio. So far we have been using Amara Raja Batteries Limited (ARBL) as an example. However, to understand leverage ratios, we will look into a company that has a sizable debt on its balance sheet. I have chosen Jain Irrigation Systems Limited (JISL). I would encourage you calculate the ratios for a company of your choice. Interest coverage ratio. The interest coverage ratio is also referred to as debt service ratio or the debt service coverage ratio. The interest coverage ratio helps us understand how much the company is earning relative to the interest burden of the company. This ratio helps us interpret how easily a company can pay its interest payments. For example, if the company has an interest burden of 100 rupees versus an income of 400 rupees, then we clearly know that the company has sufficient funds to service its debt. However, a low interest coverage ratio could mean a higher debt burden and a greater possibility of bankruptcy or default. The formula to calculate the interest coverage ratio: earnings before interest and tax interest payment. The earnings before interest and tax EBIT is EBITDA, depreciation and amortization. Let us apply this ratio on Jain Irrigation Limited. Here is the snapshot of Jain Irrigation's P&L statement for the FY14. I have highlighted the finance costs in red. We know EBIT equals revenue, expenses. To calculate the expenses, we exclude the finance cost 467 rupees and 64 paise CRS and depreciation and amortization cost 204 rupees and 54 paise from the total expenses of 5,730 rupees and 34 paise CRS. Therefore, EBIT equals 5,828 rupees and 13 paise 5,058.15 CRS. EBIT equals Rs. 769.98 CRS. We know EBIT equals EBITDA, depreciation and amortization, equals 769 rupees and 98 paise 204.54, equals Rs. 565.44. We know finance cost equals 467 rupees and 64 paise. Hence, interest coverage is equals 565.44, 467.64, equals 1.209x. The x in the above number represents a multiple. Hence 1.209x should be read as 1.209 times. Interest coverage ratio of 1.209x suggests that for every rupee of interest payment due, Jain Irrigation Limited is generating an EBIT of 1.209 times. Debt to equity ratio. This is a fairly straightforward ratio. Both the variables required for this computation can be found in the balance sheet. It measures the amount of the total debt capital with respect to the total equity capital. A value of 1 on this ratio indicates an equal amount of debt and equity capital. Higher debt to equity, more than 1, indicates higher leverage and hence one needs to be careful. Lower than 1 indicates a relatively bigger equity base with respect to the debt. The formula to calculate debt to equity ratio is total debt, total equity. Please note, the total debt here includes both the short-term debt and the long-term debt. Here is JSIL's balance sheet. I have highlighted total equity, long-term, and short-term debt. Total debt equals long-term borrowings plus short-term borrowings, equals 1,497.663 plus 2,188.915, equals 3,686 rupees .578 CRS. Total equity is 2,175 rupees 0.549 CRS. Thus, debt to equity ratio will be computed as follows. Equals 3,686.578 2,175.549 equals 1.69. Debt to asset ratio. This ratio helps us understand the asset financing pattern of the company. It conveys to us how much of the total assets are financed through debt capital. The formula to calculate the same is total debt, total assets. For JSIL, we know the total debt is 3,686 rupees 0.578 CRS. From the balance sheet, we know the total assets as 8,204 rupees 0.447 CRS. Hence the debt to asset ratio is equals 3,686.578 8,204.44 equals 0.449 or approximately 45%. This means roughly about 45% of the assets held by JSIL is financed through debt capital or creditors, and therefore 55% is financed by the owners. Needless to say, higher the percentage, the more concerned the investor would be, as it indicates higher leverage and risk. Financial leverage ratio. We briefly looked at the financial leverage ratio in the previous chapter, when we discussed about return on equity. The financial leverage ratio gives us an indication to what extent the assets are supported by equity. The formula to calculate the financial leverage ratio is average total asset, average total equity. From JSIL's FY14 balance sheet, I know the average total assets is 8,012 rupees 0.615. The average total equity is 2,171 rupees 0.755. Hence the financial leverage ratio, or simply the leverage ratio, is 8,012.615 2,171.755 equals 3.68. This means JSIL supports 3 rupees and 68 paise units of assets for every unit of equity. Do remember, higher the number, higher is the company's leverage and the more careful the investor needs to be. 10.2 Operating ratios. Operating ratios, also called activity ratios or the management ratios, indicate the efficiency of the company's operational activity. To some degree, the operating ratios reveal the management's efficiency as well. These ratios are called the asset management ratios, as these ratios indicate the efficiency with which the assets of the company are utilized. Some of the popular operating ratios are fixed assets turnover ratio, working capital turnover ratio, total assets turnover ratio, inventory turnover ratio, inventory number of days, receivable turnover ratio, days sales outstanding DSO. The above ratios combine data from both the P&L statement and balance sheet. We will understand these ratios by calculating them for Amara Raja Batteries Limited. To get a true sense of how good or bad the operating ratios of a company are, one must compare the ratios with the company's peers, competitors, or these ratios should be compared over the years for the same company. Fixed assets turnover. The ratio measures the extent of the revenue generated in comparison to its investment in fixed assets. It tells us how effectively the company uses its plant and equipment. Fixed assets include the property, plant and equipment. Higher the ratio, it means the company is effectively and efficiently managing its fixed assets. Fixed assets turnover equals operating revenues, total average asset. The assets considered while calculating the fixed assets turnover should be net of accumulated depreciation, which is nothing but the net block of the company. It should also include the capital work in progress. Also, we take the average assets for reasons discussed in the previous chapter. From ARBL's FY14 balance sheet equals 767.864 plus 461.8472. equals 614 rupees 0.855 CRS. We know the operating revenue for FY14 is 3,436 rupees and 70 paise CRS. Hence the fixed asset turnover ratio is equals 3,436.7, 614.85 equals 5.59. While evaluating this ratio, do keep in mind the stage the company is in. For a very well-established company, the company may not be utilizing its cash to invest in fixed assets. However, for a growing company, the company may invest in fixed assets and hence the fixed assets value may increase year on year. You can notice this in case of ARBLA as well. For the FY13, the fixed assets value is at 461 rupees and 80 paise CRS, and for the FY14, the fixed asset value is at 767 rupees and 80 paise CRS. This ratio is mostly used by capital-intensive industries to analyze how effectively the fixed assets of the company are used. Working capital turnover. Working capital refers to the capital required by the firm to run its day-to-day operations. To run the day-to-day operations, the company needs certain type of assets. Typically such assets are inventories, receivables, cash, etc. If you realize these are current assets, a well-managed company finances the current assets by current liabilities. The difference between the current assets and current liabilities gives us the working capital of the company. Working capital equals current assets, current liabilities. If the working capital is a positive number, it implies that the company has working capital surplus and can easily manage its day-to-day operations. However, if the working capital is negative, it means the company has a working capital deficit. Usually, if the company has a working capital deficit, they seek a working capital loan from their bankers. The concept of working capital management in itself is a huge topic in corporate finance. It includes inventory management, cash management, debtors management, etc. The company's CFO, Chief Financial Officer, strives to manage the company's working capital efficiently. Of course, we will not get into this topic as we will digress from our main topic. The working capital turnover ratio is also referred to as net sales to working capital. The working capital turnover indicates how much revenue the company generates for every unit of working capital. Suppose the ratio is 4. Then it indicates that the company generates 4 rupees in revenue for every 1 rupee of working capital. Needless to say, higher the number, better it is. Also, do remember all ratios should be compared with its peers, competitors in the same industry and with the company's past and planned ratio to get a deeper insight of its performance. The formula to calculate the working capital turnover. Working capital turnover equals revenue, average working capital. Let us implement the same for Amara Raja Batteries Limited. To begin with, we need to calculate the working capital for the FY13 and the FY14 and then find out the average. Here is the snapshot of ARBL's balance sheet. I have highlighted the current assets, red, and current liabilities, green, for both the years. The average working capital for the 2 financial years can be calculated as follows. Current assets for the FY13 1,256 rupees and 85 paise. Current liabilities for the FY13 576 rupees and 19 paise. Working capital for the FY13 680 rupees and 66 paise. Current asset for the FY14 1298 rupees and 61 paise. Current liability for the FY14 633 rupees and 70 paise. Working capital for the FY14 664 rupees and 91 paise. Average working capital 672 rupees and 78 paise. We know the revenue from operations for ARBL is 3,437 rupees CRS. Hence the working capital turnover ratio is equals 3,437, 672.78 equals 5.11 times. The number indicates that for every 1 rupee of working capital, the company is generating 5 rupees and 11 paise in terms of revenue. Higher the working capital turnover ratio, the better it is, as it indicates the company is generating better sales in comparison with the money it uses to fund the sales. Total assets turnover. This is a very straightforward ratio. It indicates the company's capability to generate revenues with the given amount of assets. Here the assets include both the fixed assets as well as current assets. A higher total asset turnover ratio compared to its historical data and competitor data means the company is using its assets well to generate more sales. Total asset turnover equals operating revenue, average total assets. The average total assets for ARBL is as follows: WS. Total assets for FY13 1,770 rupees and 50 paise CRS, and total assets for FY14 to 2,139.4 CRS. Hence, the average assets would be Rs. 1,954.95 CRS. Operating revenue FY14 is Rs. 3,437 CRS. Hence total asset turnover is equals 3,437, 1,954.95 equals 1.75 times. Inventory turnover ratio. Inventory refers to the finished goods that a company maintains in its store or showroom with an expectation of selling the finished goods to prospective clients. Typically, the company, besides keeping the goods in the store, would also keep some additional units of finished goods in its warehouse. If a company is selling popular products, then the goods in the inventory gets cleared rapidly, and the company has to replenish the inventory time and again. This is called the inventory turnover. For example, think about a bakery selling hot bread. If the bakery is popular, the baker probably knows how many pounds of bread he is likely to sell on any given day. For example, he could sell 200 pounds of bread daily. This means he has to maintain an inventory of 200 pounds of bread every day. So, in this case, the rate of replenishing the inventory and the inventory turnover is quite high. This may not be true for every business. For instance, think of a car manufacturer. Obviously, selling cars is not as easy as selling bread. If the manufacturer produces 50 cars, he may have to wait for some time before he sells these cars. Assume to sell 50 cars, his inventory capacity, he will need 3 months. This means every 3 months he turns over his inventory. Hence, in a year he turns over his inventory 4 times. Finally, if the product is really popular, the inventory turnover would be high. This is exactly what the inventory turnover ratio indicates. The formula to calculate the ratio is inventory turnover equals cost of goods sold, average inventory. Cost of goods sold is the cost involved in making the finished good. We can find this in the P&L statement of the company. Let us implement this for ARBL. To evaluate the cost of goods sold, I need to look into the expense of the company. Here is the extract of the same. Cost of materials consumed is 2,101 rupees and 19 paise CRS, and purchases of stock in trade is 211 rupees and 36 paise CRS. These line items are directly related to the cost of goods sold. Along with this, I would also like to inspect other expenses to identify any costs that are related to the cost of goods sold. Here is the extract of Note 24, which details other expenses. There are 2 expenses that are directly related to manufacturing, i.e., stores and spares consumed, which is at 44 rupees and 94 paise CRS, and the power and fuel cost, which is at 92 rupees and 25 paise CRS. Hence, the cost of goods sold equals cost of materials consumed plus purchase of stock in trade plus stores and spares consumed plus power and fuel equals 2,101.19 plus 211.36 plus 44.94 plus 92.25. COGS equals 2,449 rupees and 74 paise CRS. This takes care of the numerator. For the denominator, we just take the average inventory for the FY13 and FY14. From the balance sheet, inventory for the FY13 is 292 rupees and 85 paise CRS, and for the FY14 is 335 rupees CRS. The average works out to 313 rupees and 92 paise CRS. The inventory turnover ratio is equals 2,449.74, 313.92 equals 7.8 times, approximately 8.0 times a year. This means Amara Raja Batteries Limited turns over its inventory 8 times in a year, once in every 1.5 months. Needless to say, to get a true sense of how good or bad this number is, one should compare it with its competitors' numbers. Inventory number of days. While the inventory turnover ratio gives a sense of how many times the company replenishes their inventory, the inventory number of days gives a sense of how much time the company takes to convert its inventory into cash. Lesser the number of days, the better it is. A short inventory number of days number implies the company's products are fast moving. The formula to calculate the inventory number of days is inventory number of days equals 365 inventory turnover. The inventory number of days is usually calculated on a yearly basis. Hence, in the formula above, 365 indicates the number of days in a year. Calculating this for ARBL equals 365, 7.8 equals 46.79 days. Approximately 47.0 days. This means ARBL roughly takes about 47 days to convert its inventory into cash. Needless to say, the inventory number of days of a company should be compared with its competitors to get a sense of how the company's products are moving. Now here is something for you to think about. What would you think about the following situation? A certain company under consideration has a high inventory turnover ratio. Because of a high inventory turnover ratio, the inventory number of days is very low. On the face of it, the inventory management of this company looks good. A high inventory turnover ratio signifies that the company is replenishing its inventory quickly, which is excellent. Along with the high inventory turnover, a low inventory number of days indicate that the company is quickly able to convert its goods into cash. Again, this is a sign of great inventory management. However, what if the company has a great product, hence they are able to sell quickly, but a low production capacity? Even in this case, the inventory turnover will be high and inventory days will be low. But a low production capacity can be a bit worrisome as it raises many questions about the company's production. Why is the company not able to increase their production? Are they not able to increase production because they are short of funds? If they are short of funds, why can't they seek a bank loan? Have they approached a bank and are not been able to raise a loan successfully? If they are not able to raise a loan, why? What if the management does not have a great track record? Hence the bank's hesitation to give a loan. If funds are not a problem, why can't the company increase production? Is sourcing raw materials difficult? Is the raw material required regulated by government like coal, power, oil, etc.? Difficult access to raw material. Does that mean the business is not scalable? As you can see, if any of the points above is true, then a red flag is raised. Hence investing in the company may not be advisable. To fully understand the production issues, if any, the fundamental analyst should read through the annual report, especially the management discussion and analysis report from the beginning to the end. This means whenever you see impressive inventory numbers, always ensure to double-check the production details as well. Accounts receivable turnover ratio. Having understood the inventory turnover ratio, understanding the receivable turnover ratio should be quite easy. The receivable turnover ratio indicates how many times in a given period the company receives money, cash from its debtors and customers. Naturally, a high number indicates that the company collects cash more frequently. The formula to calculate the same is accounts receivable turnover ratio equals revenue, average receivables. From the balance sheet we know trade receivable for the FY13, 380 rupees and 67 paise CRS. Trade receivable for the FY14, Rs. 452.78 CRS. Average receivable for the FY13, 416 rupees and 72 paise. Operating revenue for the FY14, 3,437 rupees CRS. Hence the receivable turnover ratio is equals 3,437, 416.72, equals 8.24 times a year. Approximately 8.0 times. This means ARBL receives cash from its customers roughly about 8.24 times a year, once every month and a half. Days sales outstanding, DSO, average collection period, days sales in receivables. The days sales outstanding ratio illustrates the average cash collection period, i.e. the time lag between billing and collection. This calculation shows the efficiency of the company's collection department. Quicker, faster the cash is collected from the creditors, faster the cash can be used for other activities. The formula to calculate the same is days sales outstanding equals 365 receivable turnover ratio. Solving this for ARBL equals 365, 8.24 equals 44.29 days. This means AARBL takes about 45 days from the time it raises an invoice to the time it can collect. It's money against the invoice. Both receivables turnover and the DSO indicate the credit policy of the firm. A efficiently run company should strike the right balance between the credit policy and the credit it extends to its customers. Key takeaways from this chapter. Leverage ratios include interest coverage, debt to equity, debt to assets, and the financial leverage ratios. The leverage ratios mainly study the company's debt with respect to the company's ability to service a long-term debt. Interest coverage ratio inspects the company's earnings ability at the EBIT level as a multiple of its finance costs. Debt to equity ratio measures the amount of equity capital with respect to the debt capital. Debt to equity of 1 implies equal amount of debt and equity. Debt to asset ratio helps us understand the asset financing structure of the company, especially with respect to the debt. The financial leverage ratio helps us understand the extent to which the assets are financed by the owner's equity. The operating ratios, also referred to as the activity ratios, include fixed assets turnover, working capital turnover, total assets turnover. Inventory turnover, inventory number of days, receivable turnover, and day sales outstanding ratios. The fixed asset turnover ratio measures the extent of the revenue generated in comparison to its investment in fixed assets. Working capital turnover ratio indicates how much revenue the company generates for every unit of working capital. Total assets turnover indicates the company's ability to generate revenues with the given amount of assets. Inventory turnover ratio indicates how many times the company replenishes its inventory during the year. Inventory number of days represents the number of days the company takes to convert its inventory to cash. A high inventory turnover and therefore a low inventory number of days is a great combination. However, make sure this does not come at the cost of low production capacity. The receivable turnover ratio indicates how many times in a given period the company receives money from its debtors and customers. The days sales outstanding (DSO) ratio indicates the average cash collection period, i.e. the time lag between the billing and collection. 89 responses to the financial